or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Fed has got to regain its credibility that it is serious about inflation fighting.
We're dealing with a little bit of a stagflationary environment here.
I think it's important to realize that we got a lot of emotion here in this market.
Investors have become very accustomed to good returns, low volatility, and always being supported by the Fed.
This economy is not falling off a cliff today, and actually is quite resilient.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. An extraordinary Monday. Kaylee Lyons in for John Farrow, which is a good and beautiful thing. And we show you futures at negative 91, a little bit of an improvement, negative 84. That's not Dow futures. That's Standard & Poor's futures minus 2.1%. Dow futures negative 535. I guess it's a little bit to the tape, but don't tell pound sterling, Lisa.
No, and there's definitely a lot of weakness there. What we are looking at is a full-scale concern about how quickly inflation is taking off, that it is broadening, that it is becoming more protracted in people's psyches. And we are looking at the possibility of a 75 basis point rate hike as soon as July, if you take a look at where markets are pricing it, Tom.
And it's a sequence of the rate hikes and embedding it in, and the terminal rate comes up. We'll speak to Julian Emanuel about that in a moment. We're going to get through this quick. Kaylee, give me one insight on what you've seen in your reading from Sunday.
Well, basically, the only thing that you're safe to buy in this environment right now, Tom, is the dollar, because your 60-40 portfolio, not going to do it. Worst quarter for the 60-40 since 2008.
Oh, don't get me going here. She knows how to get me going. Yen, 134.49, euro, 104.66, and that strong dollar, Kaylee, mentions EM showing all the stresses, even Mexico out 2% this morning. The 2-10 spread, we did have brief inversion there. For a moment. Right now, 4 basis points. Let's call it a flat curve to be ecumenical. The 10-year real yield, 0.45%, is a higher real yield. And the yield backdrop from the 4% Italian piece out to the German 2-year up 1.1%. The U.S. 2-year 13 basis points, a 3.19% is a market adjusting to the Fed lift we may see. And we would mention also before Lisa's brief, Bitcoin Southie feel this morning. It's Lisa, I was going to buy it 55,000 and you saved me.
All right, well, maybe you can lever this one up and
what do you see,
keep
Lisa?
Going forward, we are looking not just at today, because today, not a lot on the table except for the market action. This week, massive. Wednesday, we get the FOMC rate decision, 2 p.m. Fed Chair Jay Powell speaking at 2:30. This comes as 2-year yields bake in that longer and steeper rate hiking path. Yields now exceeding 3%, 3.2%. Will they confirm that? Thursday, we get the Bank of England rate decision. This is the conundrum of the moment. How do you hike into weakness? And that is what's facing UK as they see 2-year yields climb, but longer-term expectations for growth shrink. And Friday, we get the Bank of Japan policy decision, key for a market that's not a market, at least when you look at bonds. In the FX world, very much a market, and the market is signaling record weakness, at least going back to 1998 with the yen weakening versus the dollar the most since 1998, Tom.
135 through that would really be something. We're getting through this quickly this morning. Again, futures at negative 83, doing a little bit better because we're blowing up the show to give you the best of market coverage. We're thrilled to tell you with our important research note Friday and into the weekend, Lori Kelvicina of RBC will join us later on Surveillance this morning. She makes real clear there's a growth delay. She's optimistic, but she has a growth delay from value to growth. Now, working with Edward Hyman over at Evercore ISI, Julian Emanuel joins us now, their chief equity and quantitative strategist. You have such a privilege to work with the Evercore ISI team and dovetail the micro analysis of Ed Hyman into your equity work. And the heart of it is inflation comes down, but it only gets down in the vicinity of 4%. That's a change.
Right. That is a change. That is an acknowledgement that basically what we saw last week says, well, there may be a peak somewhere in here because mathematically, if you get to nothing but base effects, you probably get a peak. but it is likely to be a higher plateau for longer. And Ed took his inflation number for 2023 up to 4%, and that's the issue. That's where the Fed has much less wiggle room than we would potentially like, given the stress that we're seeing on asset prices.
Since his days at C.J. Lawrence, we've all watched the white paper with the black marker. He got the black marker in one of my shirts once. He had to buy me a new shirt. It was a stupid black mark. Tom, oh, I'm sorry, Tom, I got you. Is the black marker calling for a recession right now?
I've been nailed with the yellow highlighter the last couple of weeks. No, Ed took his growth number down to 1.4% for 2022 a long time ago. He saw these headwinds. We still think the base case is no recession, but obviously, again, the same math that applies to the potential peaking of inflation also tells you that, 1.4% to what could be a recessionary number, there's not a lot of distance there.
Julian, when does your bear case become your base case of 2,900 in the S&P?
Well, all I can say is when we spoke about this last week, we certainly didn't envision 3 days of carnage in the markets that we've seen since we adopted that much more cautious view. And frankly, when you think about it from a trading perspective, what's been missing the entire last several months is sort of what I would call a cathartic flush out, where you get the VIX above 40, which is one of the things you need for at least a trading bottom. This week is fraught with peril.
I got like 8 questions, but Lisa's here. Just, folks, I just want to, in the carnage that we've got here and the more data checks, we need to point out that it is the Bramo base case bear case that we're talking about.
Yeah, well, this week is fraught with peril, Julian. I mean, I couldn't say it better than myself. Going forward, then, how do you determine if we've hit catharsis? Just that 40 level on the VIX, or is there something more? Is there some sort of forced selling, a disorderly unwind that we have yet to see, despite all of the pain?
So what we are likely to see, regardless of whether the markets decisively take out the May 20th low, which looks like is a distinct possibility today, certainly into Wednesday, is you're going to have an enormous amount of volume at mid-month and the end of the month. Quadruple witching, the Russell index rebalance. We'd love to see that kind of volume, 20 billion shares, perhaps 25 billion shares on a day, along with the VIX surging towards those levels. Those are the kinds of recipes for a catharsis that we think you need really to entice buyers back. And the last several weeks has not been about selling overwhelming. It's been about a complete lack of buying.
Well, and yet the case remains, Julian, that we've already seen this immense selling pressure. And even before today, the S&P 500 has already teetered on the edge of bear market territory. You already have a 10-year yield that is at 324. And we've only just seen the start of quantitative tightening. It only really has just begun because, of course, these markets are anticipatory. They're forward-looking. How long is it going to be until this market is looking even further out and saying, well, the Fed's going to actually have to pump on the brakes here a little bit, and we start to see things reversing?
Well, that is a question that watching the bond market, and one of our core theses around the view that 2022 was going to be volatile, before Russia invaded Ukraine, was the fact that the correlation between stocks and bonds in a higher inflation environment was flipping from risk on, risk off, that's been 25 years long, to a positive correlation. We will be looking for the 10-year yield, the ascent in the 10-year yield, to start to moderate a little bit. It wouldn't be a surprise if we get towards 3.5 in the near term to start to see some buyers come into bonds. That would stabilize stocks.
Okay, so maybe there's going to be eventually an entry point to buy the dip into bonds. Or do you see any entry points at this time in the equity market, anywhere that valuations have come in enough that it actually is safe to dip your toe back in yet?
I think there are pockets of value, pockets of stocks that have been proven, still growing earnings in this environment, and that are returning cash. Remember, in an environment where we are focused on return of capital, companies that can return capital successfully are names you want to own.
Are they going to return cost cutting? Because if we get an Ed Hyman 4% stability in inflation, I'm a corporation, I have to adjust.
You do, and part of the dynamic here that's causing this incremental market pricing closer to recession being a base case is the fact that all of these factors together is going to cause pressure in the labor market, which paradoxically, again, the Fed would wish to see a little bit of that. But, the difference between softish, and something else is very fine.
Julian Emanuel, thank you so much. With Evercore ISI. Lisa, I don't know where to begin on the data check here other than to say the tape's better than an hour, maybe 90 minutes ago as well. In the currency space, Lisa, there's just continued dollar advance. In sterling, I don't want to use a word like plunge, but there's just not a bid on sterling. We went from 1.2200 to 1.2182 rapidly.
So the United Kingdom is unique among the developed world because they report monthly GDP growth statistics. And this has been the second monthly negative print for the GDP in the United Kingdom. And a lot of it does have to do with them ending free COVID testing because that program gave some funding to the economy. But the fact that that was the difference highlights how much weakness there is, and all of the multi-prongs of the economy are slowing down. Tom, how do central banks deal with weakness? How do they signal that they will be more dovish, that they will pause in the face of weakness when the weakness is being driven by inflation, which they have to control by raising rates? This is the conundrum of 2022.
The conundrum to me is, as Julian Emanuel said, Lisa, the partition of inflation. Part of it is going to go away rapidly and you come down, but an Ed Hyman 4% inflation is flat out unacceptable to any central bank.
You look at projections saying even if gas prices don't climb from here, if they just stay where they are, that's going to be a big problem. But that's exactly right. That is exactly the conversation because they are moving quickly. Even that will create a real problem for consumer sentiment.
All she cares about is a gallon of gas.
No, that's all a lot of people care about. I can handle. A lot of people can't even handle this.
There we
budgets.
go. There's
so
the
this is a
Brahma
real
we
issue.
love. Negative 559 on the Dow. Stay with us on radio, on television. This is Bloomberg.
With the first word, I'm Ritika Gupta. Chinese military officials in recent months have reportedly told U.S. counterparts that the Taiwan Strait is not international waters. That is said to have caused concern within the Biden administration. The U.S. and allies say much of the strait constitutes international waters, and they routinely send naval vessels there during freedom of navigation exercises. Russia continued its assault on Ukraine's Luhansk region, pushing Ukrainian troops out of the center in what is Kyiv's last foothold in the area. President Volodymyr Zelensky, in his nightly address, called fighting over a main city there very fierce. Russia's use of cluster munitions and indiscriminate shelling in Kharkiv. The UK's financial regulator has added Credit Suisse to a watch list over concerns it hasn't sufficiently addressed risky culture. The lender has struggled to draw a line under a series of scandals. The Financial Conduct Authority told Credit Suisse last month it was adding the bank's UK operations and international unit to a list of firms warranting close monitoring. A software engineers on Google's artificial intelligence development team has gone public with claims of encountering sentient AI on the company's servers after he was suspended for sharing confidential information about the project. The Alphabet unit placed Blake Lemoine on paid leave last week on claims he's breached the firm's confidentiality policy. And Top Gun Maverick has had its box office crown stolen. Jurassic World Dominion, the sixth film in the franchise about dinosaurs that escape from an amusement park, fought off weak reviews to lead the North American box office, topping Top Gun. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
It's pretty clear that peak inflation theory, like transitory inflation theory, is kind of wrong. The Fed's forecast from March saying that inflation would be coming down to the 2s by the end of the year was frankly delusional when issued.
We're going to stop the show right here. That is Lawrence Summers, a former U.S. Secretary, Harvard president, and a really, really interesting economist. It is the call of this crisis. There's no question about that. And what's so important, Lisa, to me, Lisa and Kaylee Line's with us today, John Farrow's off, is his seminal work as a kid with a guy named Olivier Blanchard.
As a kid.
And the backdrop of Summers is a thing called hysteresis, which is if you have a slowdown in an economy, what does it do to employment trends? We're not there yet, are we? I mean, one of the great distinctions here is we're supposedly fully employed.
This is the concern. Where does employment have to go?
Right.
Where does unemployment have to go in order to get inflation down? And you know, Larry Summers has been on top of this. He warned early that this inflation wave would be much higher and faster than people expected, and he was right. So his concerns are actually worth heeding and somewhat more alarming.
I'd love to talk to him now for an extended conversation. It would be great. Here's what we know. President Biden is doing his part, jetting around the country on Air Force One to make, well, fuel demand go up. It's 63,500 gallons of fuel to make Air Force One go. Joe Matthew can do that math and joins us from Washington right now. Joe, not to be snarky, but it's Snark Monday. What's the president's plan this week to tame gasoline and inflation?
Well, book a trip to Saudi Arabia is what we're hearing. The White House has not confirmed that trip, but the president kind of did over the weekend when he was asked. He said, I'm not confirming that yet, but I'm going because of reasons other than energy. So he's going to pop up there at some point here. And boy, it says a lot about what we've been through over the last year with regard to energy prices, to see the president going to a nation that he called a pariah of the world here to try to unlock more supply. But he's going to do a little bit more than that. He's actually booking a trip to Philadelphia tomorrow as well. AFL-CIO. He's going to talk about the working economy. They really do want to point to this strong job market that you're just referring to as maybe the other side of the story from inflation here, because the messaging is not looking great. As you heard from Larry Summers, this is a White House looking back on some decisions that were made coming out of COVID. And I do wonder, Tom, if Larry Summers was in this White House the way he was during the Obama White House, and he said, look, that's too much money, you're going to create too much inflation in the COVID stimulus, I wonder if it would have actually changed the final price tag on that, because look, people felt like they were in a desperate position and had to do something.
That's called the counterfactual Matthew, Lisa. He does that with the Red Sox in late August.
We could look backwards, but really what we need to do right now is to look forward and what Joe Biden can actually, and what he will attempt to do to bring down inflation. Parsing beneath the hood, it's not just gas prices, right? I mean, this is obviously a multifaceted issue having to do with rent and a whole host of other things. However, he has talked about gas, saying that Exxon is making more money than God. Look at their profits. Are we looking at some sort of windfall tax in Washington, D.C., akin to what we saw over the United Kingdom?
Can't imagine that there would be much appetite for that on Capitol Hill right now. The president is in a messaging war. If you can't do a lot about it, the best you can do sometimes is talk about it. And the White House has been adamant about the fact that this is a global phenomenon, that this is not an American experience here. It's something that's being felt around the world. Interesting, though, when you consider the president's language most recently has been all about Vladimir Putin. We haven't even heard about COVID so much lately. It's the Putin price hike. He said it again at the Port of LA at the end of last week. The same time he called out ExxonMobil. But we have to remember, this White House is supposedly engaging with companies like Exxon right now. So it speaks to the relationship that President Biden has with oil companies when he's calling them out publicly, but also asking for help privately in terms of greater production.
Yeah, he wants them to pump more. And he also, other than Putin's price hike, continually comes back to the talking point of there still being thousands of wells that the oil companies aren't utilizing. The idea that they could produce more if they wanted to, they just aren't doing it. But Joe, as you say, he's trying to fight a messaging war here. This is something he has been trying to do for months now, and the clock is ticking. We are less than 5 months away from the midterms. I mean, how much longer does the president realistically have before the fate of November is sealed?
Well, a lot of people would tell you, Kaylee, it's already sealed, and it was before even the war in Ukraine based on historical factors. And by the way, the inflation that existed long before Vladimir Putin ever went into Ukraine. But this White House doesn't have a lot of options right now, aside from messaging. I do think that most of us overplay the idea of the impact of the president of the United States, that even Washington as a whole can have over the economy and inflation. This thing is off and running. And in many cases, the economists in our capital are watching it from the sidelines, just like we are.
Joe, we've asked 4 weeks straight here, I believe it is. It may even be 5 weeks as well. The New York Times with a splash this weekend about a one-term Biden. When does he clean out the White House just to reinvigorate the White House?
That's a real good question. It's one that we're asking a lot about. Of course, we saw Jen Psaki go away not that long ago, and that's pretty common for a press secretary. But I suspect that once we get through November, Tom, once we get through the midterms and all the messaging and the posturing going into Election Day, you're going to see quite a number of people going through that revolving door.
Joe Matthew, thank you so much. What we do here, and again, futures negative 93, reversing back down. The Dow futures a little better. The VIX out 4.95 points. Lisa, there's research that just comes in on an incredible Monday like this and through the weekend. And Carl Weinberg of High Frequency Economics with a tour de force on China. It's 2, 3, 4 pages long. I'm not going to go into the details, but he is heated. Their numbers are baloney. He says simply, where are lockdowns in the data?
And frankly, a lot of people would agree with him. Everyone's been saying if the official figure is something like 5%, you can look sub 4% in terms of GDP growth in China. And that's what the granular data is showing with China Beige Book. How does that bleed out into what we see globally in terms of a global growth perspective? Who's going to be the driver of growth at a moment when China's bowing out, India's bowing out, emerging markets are challenged? Where is the marginal growth?
And Kaylee, to what we heard from Enda Curran, the idea of, yeah, it's supply this, supply that, but maybe it's just a diminished global demand which slips in here in the summer months.
Well, and you saw that reflected to a certain extent in the inflation data we got out of China last week, the idea that people aren't buying as many goods because of the impact of inflation. And we're, of course, seeing that rotation into services. So that does help on the demand front. But also speaking of demand front, if China is able to open back up, if they figure out the COVID zero policy, that also has ripple effects globally in terms of commodities prices, because there still is going to be the lack of supply that the rest of the world is already dealing with. And China being offline actually helps that narrative.
Data check right now. Lisa, help me out. Sterling weakening now 121.78 as well. But Lisa, the tape again tips down. SPX futures negative 92. And Lisa, Bitcoin flat out can't find a bid, 23.
And frankly, right now, I got to say, one of our guests, I won't reveal who, said ahead of this market open, they were nervous. They are nervous because this feels fragile, and this is all being driven by rates.
But is it a Bramo nervous? There's levels of nervous.
You know, neurotic. What do you expect?
Stay with us.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
morning, everyone. Bloomberg surveillance, an extraordinary market. Let me get right to the data check here. Lisa Bramwitz and Kaylee Lyons with us this morning. Futures negative 92, now negative 88. They're a little bit off the bottom, but I really don't want to sell that to you. It's a churn, is how I'd put it here, with a VIX rounded up to 5.5 handles, 32.71. We heard Julian Emanuel of Evercore ISI make clear they're looking for catharsis at a 40 level, not at the 30 level. And I think Dean Kernett, expert on that, would agree with that assessment. The yield, 3.20%, a 14 basis move higher in the 2-year yield. If that's Greek to you, all you need to know is yields are surging, which I believe is prices going down. Lisa will correct me if I'm wrong on that. Oil, commodities showing a weaker growth here. Copper off, oil off 120, down from the 123 level on Brent crude. And obviously a dollar bid as well. You don't care. You want individual names. Kaylee Lyons assists. Kaylee.
Well, and of course, there are a few individual names that are more important than the tech mega caps, Tom, and we are seeing all of those under pressure in early hours this morning as this market is very worried about an aggressive Federal Reserve and higher rates to come. That's put pressure on higher multiple companies. So you have Apple down 2.9%, Amazon down more than 4%, Microsoft down 2.5%. Just these three names together comprise 15% of the S&P 500 and more than 28% of the NASDAQ 100. So if these stocks can't hold in there, it is very, very difficult for the broader market to hang in there. And of course, one asset class is definitely not hanging in there today is cryptocurrencies. Bitcoin is back below $24,000. Tom, you can make fun of me all you want, but this is very real. This is serious.
What is MicroStrategy? Wait, stop the show. Explain, Kaylee, what nobody knows that name.
Michael Saylor.
What is MicroStrategy?
It is a company that is essentially a Bitcoin proxy stock because it continually adds to Bitcoin to its balance sheet. So it is essentially trades in tandem with the cryptocurrency. Michael Saylor, of course, is a big time crypto evangelist, Tom, but it is taking it on the absolute chin this morning. It's down 25% in pre-market trading. These are monster moves, and it's not just MicroStrategy, of course. It's basically any equity that is tied to cryptocurrencies in some form. Marathon Digital down 17%, and Coinbase, which of course is the big crypto exchange, it's laying people off. It's really dealing not so great with this broader macro environment. Coinbase down 15% before the bell, Tom.
Very good. Mike Wilson of Morgan Stanley out with an important research note, and I just really want to parse it. His distinction is corporate confidence and the idea of will they conserve cash or continue use of cash share buybacks. We'll talk more about that here in a bit. Right now, we have demanded she attend today. Deborah Cunningham is with us. And what she is expert on the wicked, this is a Boston phrase, even though Federated Hermes is from Pittsburgh, a wicked short-term market. Deborah Cunningham, you are focused on not the 2-year yield, but the courage and fear to move inside of 1 year. What's happening in the 12-month or lower space?
Well, first of all, we have offices in Boston, so I'm wicked understanding the phrase. As far as the 1 year space goes, I mean, 1 year and under, you're looking at preservation of principal. If you're even in the 2 year, you're worried still about big breakouts from a pricing standpoint to the low side simply because of the rising rate environment and not having enough income yet to cover that difference. On the 1 year and under space, you don't have to worry about that preservation of principal. That's pretty much a stable value product that you're looking at. And so your return is basically what your income is generating. And that income is not huge yet, but it's continuing to go up. And you can believe June and July, it's going to go up by another 100 basis points.
Deborah, to give us a mood, to give us a feeling of the retail investor, do you see flows right now into cash accelerating in a way that is not familiar over the past 10 years?
Well, you know, the retail investor moves fairly slowly. So it's not in any kind of a huge wave or a huge force that we're seeing that yet. It's more what I'd call a trend, an operating trend that's going from the more riskier asset classes into those that are a little bit less risky, which ultimately would be the cash market, the cash asset class. So not waves, but more like, you know, trends that are heading in that direction.
Deborah, you're at the moment, you're at the heart of a lot of what people are worried about, which is liquidity problems, which is as the Fed raises rates and as the Fed withdraws liquidity, that you're going to see disruptions in some of the most safe markets, including the cash markets. Have you seen any signs of dysfunction in that market?
We haven't really seen that yet at this point. What we've seen is a lot of demand. So lots of people coming into the market, retail as well as institutional, and good supply. Good supply outside of the Treasury market. Treasuries have been low in supply because effectively bills have been being cut since tax dates back in April, and they continue to be in low supply, but with a high demand. That's why you see lower yields on the short-term Treasury bill marketplace. But when you go into credit markets, commercial paper, CDs, other types of short-term notes, they're in good supply with good liquidity and good demand at this point.
Well, but Deborah, as Lisa talks about the Fed sucking liquidity out of the market, that process has only just begun. Quantitative tightening is barely underway yet. What can we expect to unfold over the coming months as that happens in more substantial fashion, considering how far this market has already moved just in anticipation of it?
Well, as I said, Treasuries are in short supply. So to get Treasuries back into the marketplace would be a great thing. That would actually add to liquidity. From an MBS standpoint and longer-term Treasury market standpoint, you've seen the RRP, the Fed's reverse repo facility, trading, at over $2 trillion on a quantity basis for the last 2 or 3 trading sessions. And if you end up with more collateral for what I'll call the traditional repo counterparts in the marketplace, maybe that starts to bring that RRP back down a little bit and back into what would be sort of more normal supply, with the traditional counterparts of banks and broker dealers having the supply that's coming from the quantitative tightening for the Fed. So I don't see it as being a huge problem unless all of a sudden investors turn away from the cash market. We don't see that happening anytime soon.
Okay, so what kind of cracks would you be looking for? Where do you think the first thing might break if the Fed is too aggressive?
Well, I think you want to look for a lack of demand when there is all of a sudden a huge spike in pricing that's not due to inflation, that's not due to an outlook from a standpoint of normalization turning into tightening, but rather due to what I'd say would be more credit concerns. Everything we've seen so far seems to stem true from supply-demand issues, from issues from, a supply chain imbalance, the Russia-Ukraine conflict, lots of things that are contributing to it. When you start to see maybe some credit imbalances, that would be a true sign of a problem.
Deborah, thank you so much for the brief. Really appreciate it. With Federated Hermes there on Inside of 12 Months paper. This is what we're doing today, folks. We're moving around between, I forgot my glasses. Somebody said, Tom, where are the glasses? We can't have a morning. I have my Tang, but I left my glasses at home. I'm sorry. Vet bill hit them. Okay, let's move on. I want to talk, Lisa, about what I think is not being talked about, which is the greatest bear market in bonds in my lifetime. Let's go away from what the media quotes, which is full faith and credit, and look at the world of Lisa Abramowitz. She is expert at IG. And I'm sorry, Lisa, it's a minus 15%. I just looked at a GM 10-year piece, down 19%.
It's shocking. It's things that we've never seen before in this space. And the fact that we have not seen wholesale exodus from some of these portfolios is notable, and actually starting to see some money come back. Here is the issue, is that at its core, we have not seen corporates break down. The corporate fundamentals are still pretty good. So at what point do people start selling off that as well, or does that become a haven? The bigger issue for me is that the S&P is on the brink of a bear market. We are 2 percentage points away. If the moves that we're seeing pre-market hold, we are in a bear market for the S&P. Credit has not broken down in the same way. This is the reason why people think that the Federal Reserve will not step in. If you don't have that credit impulse breaking down, if companies don't need to refinance, which is the issue, then what is going to cause the Fed to say, oh my goodness, we need to back away? Nothing. And that is the reason why people are getting so bearish on stocks, even more so than credit, Tom.
Yeah, and if we can get this up, great. If we can't do it, it's fine. But Kaylee, I featured it at 5 a.m., which is over on the equity side, and the implied volatility of the Standard & Poor's 500, the VIX, where we're above 30, and everyone waking up today, even the non-sophisticated, say we're above 30, but we're not above 40. And the answer is the VIX. Yeah, it's elevated, but it's, as Lisa says, it's not that catharsis this morning.
That's the thing, Tom, is the selling is still so orderly looking. We haven't seen that volatility blowout where it seems that everyone is capitulating, everyone is just forced to sell. It hasn't happened yet. So the question is, when is that coming? And is that the only point at which people can get a little bit more optimistic and say that the bottom may be in equities? As Lisa says, we could enter a bear market today. How much lower can it go after that?
Well, we're going to have to see as well. Lisa, what does this do to issuance? I mean, I make jokes about the auction, but what do chief financial officers do when they see bonds lower, yield higher?
Well, they definitely don't issue bonds opportunistically unless they see things getting even worse down the line. They don't issue, right? I mean, you're seeing things slow down, or else they issue to get ahead of whatever may happen. But then occasionally when they do issue, they offer yields that are so attractive that everybody comes in and it's a food fight. And that's what we saw with Carnival. They actually issued bonds a couple weeks ago at this incredible coupon, and everybody flooded in because you're finally getting yield, Tom. I mean, honestly, people have been yield starved for years. This is actually really attractive for the likes of Howard Marks suddenly.
Yeah, John from Marina Piccola on Capri emails in. And,
You're sending him to Korea now?
Yeah, no, he's in Capri. And
which, north
he
or south?
says you got to quote the German 10-year more, 1.60%, out 7 basis points on German 10-year. Stay with us on radio, on television. We will do more data checks. Futures at -91.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The UK economy shrank in April at the sharpest pace in more than a year as the government reduced its COVID-19 testing. That is pointing to risks that a broader contraction is underway. Gross domestic product fell some 3% from March when output declined 0.1%, according to the National Statistics Office. French President Emmanuel Macron is facing a challenge in upcoming elections. His party and allies are likely to remain the largest bloc in the National Assembly, according to pollsters looking at the first round of votes, but Macron's majority will likely shrink, just as his margin of victory narrowed in April's presidential election from his results 5 years ago. And China is starting to reimpose those COVID-19 restrictions just weeks after a major easing in key cities. The action is raising concern the country may once again employ strict lockdowns to control its outbreak. Beijing reported 45 new local cases on Monday after having single-digit cases on most days last week. And iron ore plunged on Monday after China enacted those COVID-19 measures in major cities, which fueled worries about demand. The steel-making material fell more than 5% in Singapore for its steepest drop in close to a month amid thin trading. Beijing has been warning about its struggle to contain a fresh outbreak. And the yen fell to a 24-year low, and Japanese bonds tumbled Monday, prompting a warning from the Bank of Japan. Rising global interest rates are seen to be an issue there. The currency fell more than 5.5%, the lowest since October 1998. The yen has tumbled almost 15% this year. It is the worst performing major currency. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Isn't it, just how sensitive the markets are to any commentary about trade? We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
That we're in a recession now, and I don't see a recession this year. I think the recession will come after the Fed gets itself into a restrictive monetary posture, and that's going to take some time.
Michael Darda, absolutely brilliant. I believe that was on Friday with MKM Partners here, really looking at this focus on nominal GDP and how it slides down. We're going to talk to Gina Martin-Adams about that in a moment, the animal spirit of a turmoiled American economy. I've got Kriti Gupta in a moment, but let me do the data right now. Lisa, help me out here. It's simple. Standard & Poor's 500 futures, negative 94. They roll over near lows for the day.
Yeah, deterioration across the board, and this really is being driven by rate hiking expectations. How much did Friday's CPI print change the narrative with widespread inflation continuing to exceed and peak inflation not being peak?
But as we talked about at the top, to me it was inflation expectations and a reset of where the terminal value is out there. And again, I go back to Julian Emmanuel, which is getting inflation down to 4% is a hope, but the dream is to drive it lower.
Yeah, and we're not getting there any closer to that.
Well, there we are, and we'll give you more data here with dollar strength right now. Sterling 121.77 is at a uniquely ugly morning. On financial conditions, Kriti Gupta.
Yeah, Tom, we have to talk about the combination of all the moves, not just the stock market drop, not just the drop in treasuries and yields higher, of course, price lower, but also that dollar strength that you were just talking about. Combine all of those together with a little bit of credit spreads, and you get the financial conditions index, which actually shows that it's coming back down to levels that have served as this kind of roadmap, as this pivot point in the past for the Federal Reserve. And that brings me to my chart of the day. We are looking at the Bloomberg Financial Conditions Index. If you actually look at this chart for our radio audience, and it goes back, it's in negative territory right now. It goes back to 2018, 2016, 2015, even 2012, essentially these major pivot points where you hear from the Fed after some sort of sell-off in the broader markets that this is some time for them to speak. The most notable example being at the end of 2018, Christmas Eve of 2018, where in 2019, they at this very start, they kind of turned, the Chairman Powell turned kind of his posture around, really calming the markets to some degree. Do we get some sense of that again this week, Tom?
Kaylee, thank you so much, Kaylee. Kaylee, I got it. Pretty. And now joining us,
twister, Tom. You should use that as your warm-up before the show.
Yeah, okay. Now joining us, Kaylee Martin Adams. She's Chief Equity Strategist for Bloomberg Intelligence. Gina, you've got a team of some 200 securities types you're herding. What is the theme this morning in the Bloomberg Intelligence meeting?
Yeah, well, I think the theme for everyone is still inflation, though the market responded so viciously to the CPI print. The PPI print is actually historically much more important to driving
Why
profit
is that?
trends.
This is the three-level producer price index series. It used to be gospel 30 years ago. You're telling me it's gospel again?
It is. It's absolute gospel for the S&P 500 earnings stream. It is the price that companies pay for their input costs, so it's very meaningful. CPI might represent the cost, the price that they're able to charge, but ultimately the spread between the two is what makes margins on the S&P. And if you think back to where we were this time last year, we were talking a lot about margins as the predominant risk to the earnings stream going forward. Margins do lead earnings. Margins peaked by the third quarter of 2021, and estimates have been leading earnings estimates lower. That's a predominant source of risk in the equity market, even though we are certainly contending with a lot of volatility related to Fed policy, which is also directly related to inflation. Earnings are what ultimately drive stock prices over the long run. So to be in this margin crunch kind of environment is very difficult.
Is it all boats sinking, or with what you just said, are goods kind of companies struggling because of import prices, but service sector companies like software technology, whatever, are not?
It's a very big mix because some services companies are absolutely suffering. The consumer services companies are a good example of that, right? Restaurants, for example, they're not necessarily goods producers. They offer a service, yet they have very high input costs as a component of their overall cost structure, not only from goods, but also from labor.
Kaylee, we have to stop the show. Is McDonald's a goods or a services company?
Yeah, it counts as a services company. It's a component of the consumer services
Shake
group.
Shack is a goods, and the rest of the bags I get at the door at home. Juice Bar is a service company.
Restaurants are services. You do have goods companies also in the consumer space that are obviously struggling materially as well in the form of retailers.
Tell me sushi's not a service company. It's got to be.
I have a feeling, Tom, that any restaurant you name is going to fall.
All going to be a
Thank
service.
you. Kaylee, pick it up. I got to, look at my.
Okay, well, Gina, I'm looking at the markets this morning. An S&P 500 that looks like it very well could close in a bear market today. You have a 10-year Treasury yield breaching 325. We're now at 326, and the only thing that seems like it's safe to buy is the dollar, which is just going from strength to strength. And you're starting to see companies warning about that stronger dollar. We saw it from Microsoft cutting its outlook because of FX headwinds. Is this just an excuse, or is that real?
I think for some companies, it's certainly real. The dollar has this very fuzzy relationship with stocks, to say the least. I mean, in the index at large, 65% of the constituents actually have a positive correlation to the dollar. Those constituents' earnings streams have a positive correlation to the dollar. So most companies in the index actually benefit when the dollar rises historically. Some companies with more multinational focus that may not have been hedged properly are certainly going to experience dollar-related cost weakness or dollar-related earnings weakness, but it's not a story that you can paint the index with one big broad brush with. I mean, the dollar and S&P 500 earnings have almost zero correlation over a long-term time period. But these dollar spikes can be very meaningful. We actually wrote about this for a note that's coming out on the terminal tomorrow.
Well, good.
The dollar spikes, when you have these really, really big moves in the dollar, it can be very meaningful. At this point in time, we estimate that every 1% move in the dollar shaves about 19 cents off of the earnings stream. So it doesn't sound like a lot in the grand scheme of things, but you've got companies in tech and materials, some of the consumer space that do have exposure that is somewhat meaningful.
Okay, Gina, just over the course of that answer, I told you the 10-year Treasury yield was in and around 326. It's now about 328. So we are seeing rapid movement in the bond market as well. What does the 10-year yield approaching 330 mean for an equity market that is already in a great deal of pain?
It's very meaningful because the spread between the 10-year and the 2-year has shifted either flat or almost negative again. If we move back into negative territory, it's incredibly consequential for stocks. Yeah. What we tend to use is the 2-year actually as our framework for deriving valuation expectations for the index. So the fact that the 2-year is back to 3%, 2-year forwards back above 3% again, closer to 330, would imply that your valuation multiple on equities needs to be closer to 14 times earnings to price that kind of rates landscape in. And then you pile on top of that an inverting yield curve or flat yield curve, and that only suppresses your expectations for the multiple more.
Don't be a stranger. I got 6 more questions. Gina Martin Adams, thank you so much. We never got to the idea of cash, where she is the queen of having the courage to stay investing. Kaylee, help me here with a data check. Futures up 533.19. Excuse me, VIX up 5 points, 33.16. And Kaylee, negative 607 on Dow futures.
Yeah, it is painful out there for equities across the board, Tom. This could be bear market territory for the S&P 500 if these losses hold come the opening bell. You're seeing weakness in bonds as well. We are up 11 basis points on the 10-year yield. The move is even greater at the short end of the curve as the bond market adjusts to a Federal Reserve that it thinks potentially could move 75 basis points next month. The only thing stronger in terms of U.S. assets today, Tom, is that dollar. Euro dollar weaker by 0.6%.
Yeah, euro dollar comes in, and I'd also mention sterling having a weak recent 15 minutes. The low 121.69 on sterling. Please stay with us. The real yield over 0.5%, 0.51% on the 10-year inflation adjusted yield. Stay with us on radio and television. Negative 95 on futures. Good morning.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we got is a mid-cycle slowdown, but I don't think we have a recession going on.
This is an inflationary process that has been broadening and deepening out.
What I think that you're ignoring is the adaptability of people and the economy.
The risks of eventual recession are rising.
It's a clear signal from the Fed. We're going up and we're going fast.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
On the brink of a bear market ahead of a pivotal Fed meeting. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, John Farrow, and Lisa Abramowitz. John out. Kaylee Lyons very much in. We're very glad to have you here on this day where we are seeing deterioration. And Tom, as we've been talking all morning, it's been fluctuating and now a leg lower with the NASDAQ down more than 3% ahead of the open.
About half an hour ago, a leg lower. We're breaching through to some new low levels. I'm looking for negative 100 on SPX, haven't gotten there yet. But Lisa, negative 95 is not the negative 91 of a number of hours ago. We're looking at a tick by tick. And Lisa, the yield space is so out of kilter. When I look at the screen, I'm mixing up like the 2-year and the 10-year.
Well, I think that a lot of people are, because we did see a yield curve inversion, meaning that they were the same. And then even the 2-year yield exceeded that 10-year yield briefly before reverting back to the normal that we hope for. And we're looking right now at the highest yields on the 2-year going back to 2007. What can the Fed, Tom, say in this market?
Well, what they're going to say, and the reading is, and I think of Ibn Rabari at Citigroup about 5 hours ago, I'm going to say, making clear they felt 75 basis points is unlikely. It's a parlor game. It's something to talk about, chat about. Maybe you extend it out to July 27, which is just another way of saying you need more data. But what data do they need to? Look at the headline coming out right now with a 328 10-year. We're back to 2011.
And Kaylee, I keep focusing on the NASDAQ because the NASDAQ's pain has been so much deeper than the S&P's in a way that's really reminiscent of the early 2000s of the dot-com crash. Can you give us a sense of what people are doing with that? Because we heard for a hot second that people were going into tech, and then not so much, because frankly, it is just interest rate sensitive, and we are looking at that interest rate sensitivity absolutely get hammered.
Yeah, that has been the story of 2022 so far, why we've seen tech underperforming the broader market to such a degree, because while these companies have gotten a lot cheaper because of how much prices have come in, they are still more expensive than other areas of the market. And do you want to be paying those higher multiples in an environment of higher interest rates that only if you listen to the bond market and what the pricing is in terms of hikes from the Federal Reserve, they're just going to continue to get higher. So is that kind of duration equity asset something that you want to hold in that kind of environment? By and large, the answer has been no, and you're seeing that borne out again today.
Tom, again, this market has just made some massive moves, and we're looking at deterioration, as you said. But taking a step back, we are looking at a bear market, finally, what people have been looking for. And just to make clear, I know that I've been called bearish across the board and looking for gloom and doom. It's not a positive thing. Nobody wants to see pain in the economy. Nobody wants to see real people struggle. And what we're looking for is some sort of floor to give us a sense of what's ahead. But it's the issue of hiking into weakness that's the theme of this week.
The floor is not there, and the catharsis is not there either. 33.01 on the VIX, 33.01, 5 big figures. SPX futures at negative 91. Dow futures were negative 600 plus, now negative 584. I'm going to hit all the complexes quickly, including including BitDog. I'll do that in a moment. The 10-year yield, 3.26%. That's an 11 basis point move, not curve inversion, 5 basis points of normative slope there right now. Crude, softer on growth worries, 120 on Brent crude. Dollar, stronger. Yen, 134.41. I noticed sterling with a BOE this week, 121.76. And copper shows China's not going to grow soon. Lisa?
Honestly, it's been such a rough market. I keep going back to one guest before we went on air. She said, this is getting me a little nervous. Today's trading action. Matt Hornbach has been nailing all the calls of the team with Morgan Stanley, head of global macro strategy there. And Matt, are we seeing catharsis today?
Well, I don't know if it's catharsis, but I do think it makes sense in the wake of an astoundingly strong CPI report on Friday. This economy is going to require higher real yields to slow down and to put some downward pressure on inflation. And that's exactly what we're seeing this morning with yields up across the board, real yields leading the move higher. And the yield curve flatter. One of our key themes at Morgan Stanley has been the flattening of the yield curve, and we do think it will invert again, as it did this morning, and it will invert to levels that we have not seen in decades.
Matt, you are an outstanding student of behavior with your expertise on Japan. Your Michael Wilson is maybe the strategist of the moment with a real cautious call on 2001 into this year. He looks this morning for a change in corporate behavior. Do you agree?
Well, interestingly, I just came from a trip to Japan. I was out there last week with a colleague, Jay Backow, who runs our securitized products research. And, what we saw out in Japan suggests that until you start to get some inflation, you shouldn't expect to see corporations change their behavior. And I think because we have inflation here in the U.S., it certainly makes sense to me that we're going to see some changing behavior out of U.S. corporates. I mean, the dollar strengthening again this morning should ultimately result in some change at the U.S. corporate level.
Okay, well, let's talk then more about U.S. inflation and the Fed's policy response to that. Steve Englander over at Stanchart publishing this morning saying he sees 50 basis points in June, July, and September, 25 basis points in November. He says the reason why he's sticking with 50 is because of indications that activity is slowing down, so the Fed has to avoid overdoing it and having an abrupt about face. The market is also now pricing in rate cuts in the second half of 2023. Matt, is this just a story of the Fed moving aggressively now and then having to cut in rather quick fashion after the fact?
Well, I mean, that's what it looks like in market pricing. But I would just, remind your listeners and your viewers that last year, the market thought the Fed terminal rate would be 1.5% looking out into 2022, 2023. So the forward market has a guess as to what's going on, but it's typically the wrong guess. So I wouldn't spend too much time focusing on what's going on in the longer dated forwards. But to the point of going 50s, I mean, look, the Fed doesn't have much reason at this point to slow the pace of rate hikes until it at least gets policy rates to a neutral setting, which ultimately would imply a string of 50s between now and the September FOMC meeting.
How close is the Morgan Stanley view right now, Matt, to the Deutsche Bank view, a 4.125% terminal rate at some point next year?
Well, Lisa, that's not our view at the moment. Ellen Zentner, who runs our U.S. economics effort, she currently has the terminal rate in the low threes. But, let's be honest, things are changing very quickly, and the inflation data is surprising our economists to the upside as it's surprising most people to the upside. So we're certainly not alone in that sense.
Matt, John from Marina Grande Capri, he's asking of Italy this morning. I did a log study, Matt, and it's indicative of some of these stretched series, and that it's what's called log convex, which means the second derivative is increasing to a greater point of tension. How log convex is the market right now?
Well, I mean, ultimately, I think the markets are completely riding on what's going on in the central bank community, and the central bank community is moving more and more aggressively towards tighter monetary policies. Inflation is really the Achilles heel of risk markets because central banks with inflation mandates have to respond if inflation is going up. and might not come down anytime soon. And that's what we're starting to see is just central banks moving more and more aggressively. And that's going to put upward pressure on real interest rates. And when real interest rates go higher, valuations have to come down.
Matt Hornbach, thank you so much. Greatly appreciate it. With Morgan Stanley this morning. Futures at -91. Dow futures -589. The VIX 32.97, up 5 big figures. Lisa, one of our high points in Davos was a banking conversation with a banker from Boston and Bank of America, one Brian Moynihan. B of A out reaffirming here what Moynihan was talking about was, you know what? The consumer's strong. Yeah, the markets are moving. Credit remains really strong. B of A sees mortgage loan growth keeping pace and continuing. I'm lost.
Kaylee pointed this out, some headlines coming from Bank of America, reiterating what we're hearing, frankly, from all of the banks. They're saying credit is holding in there because companies are doing well. Consumers are doing well. It's, to use your word, Tom, the partition between now and then. Now and what's going to happen in 6 months. How do you game that out, given how high rates are, how high they're likely to go, and given consumers feeling crimped by higher gas prices, rent prices, and everything else?
Kaylee, if we get an Ed Hyman 4% inflation out there somewhere and I had 2% growth, that's 6% nominal GDP, which goes back to the animal spirit that Fortress Moynihan is seeing.
Well, and that's what they're reiterating now, is that the growth picture actually doesn't look all too bad at this moment. And I look at these kind of headlines, Tom, and I'm wondering, is that a good thing for the Federal Reserve because it means the economy is strong, that they can be aggressive and they're actually going to be able to execute a soft landing? Or is the idea that the consumer is still willing to borrow, still willing to take out mortgages, even as rates go higher, mean that the Fed is going to have a much tougher job actually seeing the transmission mechanism in that higher rates actually slow down activity and bring down prices? If the consumer is willing to spend regardless of what rates are, how does the Fed do its job?
Lisa, look at the real yield. Matt Hornbach mentioned
looking at that.
And you were you?
Of course I was. He mentioned this.
Well, that's because you drank the Pharaoh Kool-Aid. 0.51%. It's, it's up 14 basis points. This is it, folks. What this is on radio, I've got the hands thing going. This is the nominal yield moving up much more than the inflation yield, which
that works
gives
really
you
well on radio.
that residual.
It's fantastic. Gives people incredible.
Like,
what was that thing that you did that one day?
Someone get Tom some
this?
I know exactly. He should just,
No, it's like Big Jet TV. I'm landing a 777.
We're teasing a show that already happened.
Futures at -87. Please stay with us on radio and TV. More data checks. Markets moving.
Keeping you up to date with news from around the world with the first word. I'm Ritika Gupta. Russia continued its assault on Ukraine's Luhansk region, pushing Ukrainian troops out of the center of what is Kyiv's last foothold in the area. President Volodymyr Zelensky, in his nightly address, called fighting over a main city there very fierce. Ukraine's top military commander has pleaded with his U.S. counterpart to send more artillery. And Chinese military officials in recent months have reportedly told U.S. counterparts that the Taiwan Strait is not international waters. That is said to have caused concern within the Biden administration. The U.S. and allies say much of the strait constitutes international waters, and they routinely send naval vessels there during freedom of navigation exercises. A software engineer on Google's artificial intelligence development team has gone public with claims of encountering sentient AI on the company's servers after he was suspended for sharing confidential information about the product. The Alphabet unit placed Blake Lemoine on paid leave last week on claims he breached the firm's confidentiality policy. And crypto lender Celsius Network paused withdrawals, swaps and transfers, triggering a broad cryptocurrency sell-off and prompting a competitor to announce a potential bid for its assets. Doubts about the high yields backing products such as those Celsius offers have intensified after tighter monetary policy across the world helped curb demand for riskier assets. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
One of the big reasons why the price of gas is so high in the United States is that refinery margins, the profits that refineries are charging, have hit historic levels. We need industry and the government to work together here to try to get more supply onto the market.
Brian Deese of the White House, Director of National Economic Council there, talking up a gallon of gas, which is truly front and center. We're doing more data checks. We've got a little bit of a lift in a tape that was ugly over the last 45 minutes. Futures were negative 95. They're now negative 85. A little better tape. The VIX up 5 big figures, 32.61. Dollar still ascendant. Euro dollar 104.57. Yen doesn't get to 135, 134.38. Weaker currencies against a stronger dollar. Brent crude 120.42. As Brian Deese was talking about a gallon of gas, there's an entire another story in hydrocarbons. Darway Kung joins us now, head of commodities, DWS, and we're just thrilled he could join us here on what I've ignored, and I've been remiss on this, Darway, which is natural gas. No one talks about the price of a gallon of natural gas, do they?
It's much less known, but outside of U.S., I'm sure people are very concerned about high price of natural gas. U.S. natural gas has gone up multiple times of the price since the beginning of the year. And the strong demand coupled with a limited production growth and now more robust export demand has driven up U.S. prices as well.
You are so good at the fundamentals of all of this and the underlying fundamentals of export-import pressure of hydrocarbons in the United States. Describe right now who's going to win the battle. Do we export more? Do we keep it instead of exporting it? Do we start to import hydrocarbons again?
At this point, in the near term, we are fairly maxed out on export capacity, and that won't change until we anticipate 2024 and beyond. And there are scheduled projects to come online to convert our natural gas into liquid form that can be exported. Our export capacity to Mexico via pipeline is fairly maxed out, and we always have some import and export between Canada and U.S. to deliver gas from places that's less accessible in each country. But most of those pipelines are at maximum capacity. In the near term, we're not going to see a significant dynamic change. Given how low U.S. price still is compared to the global price, we're less than about between a half to a third of global price. The pressure will be there for U.S. to export more once that pipeline, once that capacity to export liquid natural gas increases in the near term.
From natural gas to crude gas, refined goods, gasoline, and diesel, the fact that we're seeing such incredible lifts in gasoline prices, really basically regardless of what happens in the Brent crude market, at what point do prices fall enough for it to actually matter for refined goods, given the lack of refineries?
Well, that's a great question. I think in the near term, we still see strong draws from gasoline inventory. Up to this point, we should have been seeing seasonal build in gasoline inventory as refiners prepare for summer. And we've seen just the opposite. So that natural demand draw will continue. I think that the solution to high gasoline price really comes from demand reduction. We have to see a significant demand reduction to allow for the price to fall. We still see quite a bit of pinned-up driving demand, and that's driving the gasoline price right now.
So how long or at what level will that demand destruction really start to kick in? How far away are we from that?
We're anticipating a year from now, we'll probably see less of that recovery demand from COVID-19, ex-China, and that should help with the price next summer. Unfortunately, for this summer, we probably won't see that realized.
Well, you mentioned China. Obviously, COVID-0 still an overhang in that economy. You're still seeing large parts of it dealing with restrictions to contain the virus. Shanghai, just one example. If and when China opens back up, what does that do to this entire supply and demand dynamic globally?
Well, that's a great question. The timing is very important. We do anticipate the additional stimulus program that's well announced ahead of time, both fiscal and monetary, to help with demand growth in China. However, it's very difficult to tell exactly when that's going to take place. Even recently, we've seen additional lockdown efforts again from Shanghai just because of the zero COVID-19 infection policy still in effect. Without that being resolved, we don't see the demand coming back up. We do hope, though, in the next 12 months, as the demand go down, we anticipate demand go down ex-China because of all the interest rate moves U.S. has made and other countries are like to follow. We are hoping that the demand from China will help balance that downward movement and keep the price stabilized in the near term.
Darway, Citigroup put out a report overnight where they were talking about how the amount of GDP destruction from where gas prices, where oil prices are right now, is really reminiscent of what we saw in the 1970s. Do you think that that oil shock analogy is the right one?
It's similar. We do see both, in both situations, we see sharp rising oil prices, and we've seen artificial constraints on supply, which were resulting, as we have seen before, eventually we're going to see demand destruction. Whether we see a significant destruction that leads to a significant economic downturn or a more moderate, a soft landing scenario, that will determine the outcome of oil price going forward.
Darway, thank you so much. Darway coming with us today with DWS here on commodities. We'll get him back here soon, particularly on the commodity dynamics of China. I can finally report this morning there is a pause in the plunge. The tape is simply better. Even Bitcoin moving out of a 23,000 level back up above 24,000. But Lisa, it's the first time I've got a correlated lift off the bottom and the deterioration we've seen through the morning.
And it's not a retracement, to be very clear. This is simply a lift. It is simply a bottom. It is simply a feeling that perhaps it's not going to keep plunging. It's setting us up for the first bear market that we've really seen. And this is the S&P down 20%. That is what we're poised for. The NASDAQ down much more. At what point do you get capitulation? That is the issue. And that's why I think it's good that you're looking at the VIX. How much does that signal an expectation of volatility, Tom?
Yeah, well, the expectation there is a 32.49, and one of the important insights this morning was a number of guests really looking at 40 level on VIX as being catharsis, and we really don't see that right now. Futures were negative 96. This is S&P futures, I should point out. That's an odd number. Negative 96, now negative 81. So an improvement in the tape. Dow futures were negative 600-ish, negative 512 there as well. And the VIX doesn't come in all that much. Maybe we'll see that in the next 20 minutes as well. The 10-year yield, get used to it, 3.25%. Dollar strength and Brent crude, we do for Dawei Kung, 120.38. Please stay with us on radio and television with more data checks this morning. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Surveillance. Good morning. Jonathan Farrell, Lisa Browitz, and Tom King. Mr. Farrell off. Kaylee Lines pulling the short straw and is with us today. And the straw that broke the back of this market, well, maybe it was the inflation report or the inflation expectations report. An ugly morning, and there is a bid in the market. Futures negative 96, now negative 83. Dow futures negative 600-ish, negative 531. There's a lift to the tape here. NASDAQ down 2.7%. Oh, excuse me. VIX up 5 big figures, now up 4.73 big figures. Stronger dollar. I mean, Lisa, how strong is the stronger dollar? I mean, it's stronger, but it didn't like break out.
Well, it broke out versus the yen, and this highlighted the differentiation in the monetary policies of the two nations, and it's breaking out when it comes to the euro, and there's a question of what the floor will be for the euro versus the dollar, now 104.7. How much do we see this push the stress points at a time when perhaps policy isn't doing the trick? And I point to the Bank of Japan on Friday for that one.
Yeah, 134 with a test of 135 on yen. The tang this morning is too strong. We'll
let them know. They'll be very concerned. They'll water it down with Velveeta.
No, they don't. No, we use Evian usually. We want to, keep it more attractive. This is an important interview. Stephen Whiting cut his teeth with the best profit analysis I know in economics of anyone in the street. He's earned his way into being chief economist at Citi Global Wealth and joins us this morning. Stephen Whiting, let's go to your wheelhouse. Are profits threatened?
Yes, we are in a period of very high profits, and that makes them more vulnerable. We think that 2023 will be a year of decline for EPS. At this point, again, we don't see the need for a plunge in every industry's profits. We don't see a need to unwind all of the gains that we've had over the last couple of years. But clearly the impact of stimulus, fiscal stimulus on demand, bled through into profits in a positive way. That's how we had a 47% EPS year last year. Now, this means downward earnings estimate revisions. This is not going to be a year of 10% EPS gains followed by another next year. I do think share prices already understand this. In other words, the drop is already, to some extent, said that these estimates are nonsense.
Steve, when we get tested like this, do companies that display free cash flow persistency, do they go down with everything else, or do they partition and separate from the gloom?
They do. And it really often comes down to dividend coverage, dividend delivery. Again, it's really boring stuff, but good stuff. If we take a look at U.S. shares that have the most consistent long-run dividend increases, they've fallen half as much as the broad market, and they yield nearly twice as much. So this is an area, again, to hide out in our own discretionary portfolios. We have 11% of all discretionary portfolios, U.S. or non-U.S., and for any asset class, benchmarked to that particular type of style investing. Again, and these were not the companies that could gain in 2020. They weren't the tech solutions, and they weren't the really beaten down cyclicals of 2021. So they didn't perform terribly well for the last couple of years. And we think they're a very good place again now in a market that's far from perfect.
Stephen, what's the distance between now and later? And I look at Bank of America putting out this idea of...
That's just way too existential. What did you say?
This idea that you have a consumer that's strong, you have corporations that are strong. How far is the distance from now to a lesser now, to one that people are forecasting in the prices of stocks?
So look, some of the lagging indicators like inflation will take a long time to roll over, but it doesn't mean we have to assume that inflation will rise forever. And just because consumer fundamentals are firm in many ways, a lot is chipping against it. So we would expect, for example, this slowdown in goods consumption to result in lesser need for employment. So employment growth will be slowing down by later in the year. You won't be able to say that a low unemployment rate is the reason why nothing's going to go wrong. I don't want to seem ultra bearish here, but this is, again, the reasons why I think from a forward-looking perspective in terms of monetary policy, you can't say, well, We need to raise rates until inflation is low. By then, you will have created the forward-looking conditions for a much, much deeper decline in the economy than you're aiming for.
Alan Blinder, the former Fed vice chair, came out over the weekend in a story and said the chair of the Fed doesn't want to let the R word slip out of his mouth in a positive way, that we need a recession. But there are a lot of euphemisms, and he'll use them. Stephen, what are we going to hear from him on Wednesday?
It'll be very interesting because you can't really satisfy markets over short-term inflation outcomes. You know, again, we've kind of joked around. It's like, well, you know, why don't you raise rates 1,000 basis points? And it's like, what will that do to next month's CPI reading? And there's very little they can do. I think that there has been less acknowledgement than we might have seen. And everybody's probably spending so much time criticizing the Fed. It's too easy for all of us. But supply shocks, periods in which we have instability in the economy. Think about, we were just talking earlier on the break, airfares have shot up by 32% over 2 months. That's non-annualized. Well, what were we seeing at goods prices last year? The same thing. The sources of demand in the economy are too unstable. We think monetary policy can take care of everything. It can't. These are periods where we don't stabilize consumer prices in the short term.
Stephen Whiting with us, and we continue with Citigroup Private Bank. I want to look at a better tape right now. Futures negative 96, up 10 points, negative 86 on futures. Dow futures negative 547. Yields do a little better. Really across the Bloomberg screen, everything doing better. Even the 210 spread from quick inversion 2 hours ago, we're now up 10 basis points on the 210 spread. Kaylee?
Well, on the subject of the 2-year, yes, things have moderated, Tom, but you are still seeing that selling pressure in the short end of the curve. I was just taking a look at what has happened to the 2-year Treasury yield in the month of June. And keep in mind, it's only June 13th. We're not even halfway there, and we're not yet to the Fed decision on Wednesday. That 2-year Treasury yield is up 61 basis points. This is a market that has moved incredibly quickly, Stephen, now to price in 175 basis points of tightening by the Federal Reserve, or hikes by the Federal Reserve by September. So I guess one word question, 75? And I say that with a little shrug for our listeners on radio.
Well, look, if they're going to do 75, it's better to do it sooner than later when policy is still at a very low interest rate. But it also goes to the fact that they've kind of lost control of the dialogue over this. I mean, they need a monetary policy approach that they can sustain. Just take a look at the history of Fed tightening cycles. Over the last 45 years, when the Federal Reserve reaches its maximum policy rate, it's only kept it before cutting 7 months on average. And if you really wanted, again, to deal with the longer-term inflationary imbalances in the economy, you want a monetary policy that you can sustain. Now, again, you could game this out. Maybe I'm the wrong person to guess this, but if you just had created a shock and awe effect where everyone believes, okay, this is under wraps, and then a couple months later, the CPI is still rising, I don't know what you've accomplished. If you were tightening so much that you have a recession and then you have an easing cycle and you are doing QT, so now you've got to do QE again. This whole approach, again, of the Federal Reserve going from feast to famine and back, again, in a pro-cyclical way. I mean, look, the mistake that was made was easing in a boom last year. You can make 2 mistakes of monetary policy, not just one. So I think, again, trying to satisfy the market and short-term inflation outcomes might be the wrong approach, at least as far as I'm concerned.
Okay, so what you're describing, Stephen, is essentially Jerome Powell with an impossible job, that he just can't do this right. Either you're going to upset the market but potentially get inflation under control, or you don't want to move too aggressively and surprise the market. Therefore, inflation is allowed to run hotter for longer. Is it that binary realistically?
Well, the one thing that we just can't dispute is the fact that monetary policy doesn't have complete control of the economy. There are really positive developments beneath the surface on the supply side. You know, you could see the price of appliances was down. Okay, why? Well, consumer goods production is now rising 4.5% in unit terms. Consumer goods consumption is falling. Imports are rising 12%. If you want to get through this, you know, we need to get through the next leg of it, which is going to be services, which is going to be housing-related issues. Do you really want to create more instability? I think they're going to be in an environment where they're trying to avoid that and still communicate effectively. Maybe they can't do both.
Stephen Whiting, thank you so much. Great brief this morning with Citi Global Wealth Management here with some turmoil and a little bit of a pullback. Boy, I'll tell you, it's flighty, Lisa. I mean, there's no real bid out there. We just are not going down like we were earlier.
Correct. I think that's a good way of framing it right now. And I think the 2-year yield is really what's driving a lot of this. Suddenly, people are looking at more intractable inflation, a Federal Reserve that has to deal with it. What is Fed Chair Jay Powell going to say on Wednesday, Tom?
Well, we will have to see as well. Lisa, just because I know you're going to wander off to do the open here, we need to send surveillance birthday greetings to Bosa El Arian.
Bosa.
Bosa's ensconced on the lawn at Cambridge. This is the dog of the El Arian house.
Happy birthday, Bosa.
Bosa nailed the inflation call along with Dr. Ilarian, you know.
No, Dr. Ilarian has been absolutely brilliant on inflation and the tractable. Bosa also, his yapping has been incredibly instructive in our inflation outlook.
They had a cat that thought it was transitory, and Ilarian threw him in the river there. It goes behind the campus.
Most people don't have the same treatment of their pets, you know.
Okay, well, we say birthday greetings there to Dr. Ilarian and the beast. It's a tough life, Lisa. I mean, the dog is like lots of student hugs at Cambridge. You know.
How much are you paying for vet bills haircut these days?
You really.
Inflation.
You got an important guest coming up, Lisa.
Jay Pawlowski, we're going to be speaking with as we carry you into the open. And again, if this move holds, bear market in the S&P. We'll be speaking with Jay Pawlowski about that at TPW.
Stay with us. Futures at -87, and we say good morning on Bloomberg Radio, Bloomberg Television.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Amnesty International on Monday accused Russia of war crimes in Ukraine, saying attacks on Kharkiv, many using banned cluster bombs, had killed hundreds of civilians. The report citing, quote, repeated bombardments of residential neighborhoods. Ukraine President Volodymyr Zelensky says Russia's death toll from the war could surpass 40,000 in June. Lloyds Banking Group will pay staff more money this summer as the cost of living spirals in the UK. Britain's biggest mortgage lender will make the one-time payment in August to more than 64,000 employees, covering all staff apart from senior executives. That's according to an internal memo seen by Bloomberg. Prices are rising in the UK at the quickest pace in 40 years. The UK's financial regulator has added Credit Suisse to a watch list over concerns it hasn't sufficiently addressed risky culture. The lender has struggled to draw a line under a series of scandals. The Financial Conduct Authority told Credit Suisse last month it was adding the bank's UK operations and international unit to a list of firms warranting close monitoring. French President Emmanuel Macron is facing a challenge in upcoming elections. His party and allies are likely to remain the largest bloc in the National Assembly, according to pollsters looking at the first round of votes. But Macron's majority will likely shrink, just as his margin of victory narrowed in April's presidential election from his result 5 years ago. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The risks of eventual recession are rising, but I think what's clear from all the data that we're getting over the last few weeks and last few months is that this economy is not falling off a cliff today and actually is quite resilient. So I think that eventually those risks are rising, but for the here and now, I think people are getting maybe a little pessimistic, too early.
A grown-up book, folks, that you may want to read. Dan Suzuki has the privilege of working with Richard Bernstein, and I can't say enough about a book that is not dated but written decades ago. Style Investing is a really, really smart effort by Richard Bernstein. Quickly, Kaylee lines with the markets moving, futures negative 90, a bit of a pullback, not near lows, but you know, there's an ebb to it. There's a real tension in the market. Two ideas. Euro-Hungarian forint has just reached record Hungarian weakness. We don't need to spend a lot of time on this, Kaylee, but this is like, be careful what you wish for in real estate, and that a lot of real estate in Eastern Europe is hinged off this with Swiss banking. So that's worth watching. And moments ago, Julia Coronado, who's just excellent, just taking a sentence out of her note, Kaylee, mortgage rates at 6% by the end of the week, according to Coronado.
Yeah, I'm really glad I'm not in the market to buy a house right now, Tom. But how does that track with the comments we heard out of the Bank of America CFO, Alistair Borthwick, earlier speaking at a conference saying that mortgage loan growth is still keeping pace. It's still holding in there. People are still willing to borrow even as rates go higher. I guess the question is, how long will that remain the case as we see the Federal Reserve continually hiking, potentially even more aggressively in the wake of last week's inflation data?
Right.
When does that start to slow housing in a more material way?
Usually at a dog and pony, if you have to say your trading team is, quote, done great, the radar goes up. It's not a lot of money, but the CFO of Bank of America says leverage finance right down is about 100 million, something around there. Not a lot of money, but we'll go with it. I demanded after Friday's Zeitgeist, where she was the focus of attention in the markets Friday afternoon. Lori Calvasina joins us now, head of U.S. equity strategy at RBC Capital Markets. What's so extraordinary about the Calvasina view, Lori? What's the distinction that got global Wall Street's attention this weekend?
You tell me, Tom. I mean, I try to keep a cool head in topsy-turvy markets, whether it's to the upside or to the downside. But look, I will tell you, I think we were at a crossroads back in mid-May. We wrote a piece titled that, saying that if the market kind of broke below the 3,800, 3,850 type level, exited growth scare territory, that we'd be pricing in a full recession. We bounced back, and we're right now right back at that crossroads. And I think it's very interesting. The market did not break 3,900 on Friday. That May 19th low actually ended up holding. I also thought it was interesting, frankly, that the small cap space, while it did get hit as hard as the S&P 500, it didn't get hit materially worse on Friday. That's important because we had seen that positioning had already been washed out in the futures market there. The peak in small cap came last March versus large. Right. And, you know, I think we can start to sort of look for areas of the market now that have been de-risked, even though there may be more risk in the aggregate.
We have focused, and we did this to great credit to our team Thursday and Friday, on the 5-year out, 5-year view of inflation from the University of Michigan survey. Lori, you highlight that. If we have a reset to higher inflation expectations, is that good for equities or less good?
I think that it keeps the value trade going forward, and I think that ends up being a destabilizing force for the equity market, simply because we do need that growth side to really stabilize. That's really where more of the market cap is in the S&P 500 these days. But we actually just took a look at how different sectors in the market have traded in regards to that University of Michigan 5-year inflation expectation number. People used to make fun of me for using it. It actually, you know, turned out it was good we had it. Energy, materials, financials, and even in the big cap space, REITs that tend to outperform when inflation expectations are rising. So if that trend continues, it's, you know, going to let this value trade live a little bit longer and keep some pressure on the growth trade, which again is a pressure on the S&P.
Yeah, and we've certainly seen growth bearing the bulk of the selling pressure. The NASDAQ 100 is down 27.5% year to date. But even beyond tech, there's been more pain for one area in particular, Lori, retail. The S&P 500 retailing index is down a full 30 percentage points so far in 2022. Of course, you've heard from Target cutting its outlook twice, the focus really being on margins. When are we going to start to see that bleeding into more areas of this market? Because it started with retail, does it end there?
It's a great question, Kaylee. And one of the things we point out in our piece is that if you look at the declines we've seen in the consumer discretionary sector, as well as the communication services sector, which has a lot of, you know, sort of consumer sensitive names in it as well, the declines we've already seen in those sectors are very close to the average declines that we've seen in them in the past 4 recessions. Now, what's interesting, if we are headed into a recession, areas like financials, industrials, materials should have been underperforming. That's part of the historical recession playbook, that those cyclical areas tend to underperform heading into recessions, though they, of course, do quite well in the rebounds. Another one that we've been talking to people a little bit about is energy. Energy has, you know, actually done quite well this year for obvious reasons, but heading into recessions, it does normally see decline. So I think it's fair to ask whether some of those winners that we've seen year to date, if this recession fear really does continue to take hold, are they going to continue to see that resilience, or will there be a bit of a catch down?
Okay, so maybe you don't want to continue to buy into areas of the market that have been ripping, Lori, but you mentioned that there are some now pockets of this market in which you've seen enough de-risking that maybe it provides some kind of an entry point. What would those be?
So one place we've been putting people towards is small caps. And we're technically neutral on small cap versus large cap, but we did say if you've been underweight, now we think is the time to remove that underweight and get back to neutral. And really, when we look at the positioning data on the CFTC work, you've been below financial crisis lows. Valuations are cheap, not just in relative terms, but they're also getting pretty darn close to where they tend to bottom out in recent years if you're not in a massive recession like the financial crisis. So we've got a clear valuation appeal. What we don't have, right, is a fundamental tailwind here. This is not really an area you typically want to be in when the Fed is hiking rates, when GDP growth is slowing, when ISM is falling. But we do know that risk started to get priced in very early. And historically, recessions are great buying opportunities for
Right.
that part of the market.
And for those of you that want to know, Lori Calvasina, catch down is a phrase from CFA Level 5. That's where she got that from.
You know where she probably learned that, Tom?
I'm-
The great University of Virginia. She is a fellow Cavalier.
Oh, my word. Pause for a moment.
Yeah, go Who's.
Okay, Lori Calvasina with us. Thank you. We'll do something in Darden here in the future. RBC Capital Markets. And Kaylee Lyons as well. Kaylee, there's a lot to talk about here right now. And one of them is the tape gets a bid and then it doesn't. The fragility here is tangible.
It is. We've seen futures kind of stabilizing as we draw closer to the opening bell, in that we remain in this range kind of in and around 3,800, 3,820, Tom. But still at these levels, we could see the S&P 500 opening in a bear market. Of course, the NASDAQ is already there, but it really just goes to show you the concern around last week's inflation data and the idea that the Fed is going to have to be even more aggressive. 10-year Treasury yield, break of 325.
We're going to exit optimistic. Stephen Stanley, Amherst Pierpont, a blistering short note. He's optimistic. Households have massive spending power. That from Stephen Stanley. Thanks to our team for blowing up the show today through the morning on Bloomberg Radio and Bloomberg Television. Good morning.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Hello traders, how are you doing today? At
the British pound moved in our favor, and I'm going to place an order to sell British pound against United States dollar at 122. Okay, it will give us 3,000 pounds in profit. So if you was following my trades, we was keeping these for quite a while, as you remember, about a week or few weeks. So when we sold short position, it's moved rapidly higher. So we've been waiting. In reality, we didn't lose anything at all. We trade on margin, and broker pays us overnight price because it was short position. Right now, the time to place order and sell short position. So if it will move to 122, I will close position at 3,000 pounds in profit. Okay, guys, please copy this trade and stay with me, and I'll speak to you later.
Likely from Friday onwards.
But this does definitely put 75 on the table.
We absolutely think they should hike by 75 basis points.
That would send panic signals across global markets.
I would be sort of really doubting that we get a 75 basis point hike out of the blue.
The hope that bad news would be good news and to create a reversal in this market, it's just falling away in front of us.
The problem really for risk assets in total is sort of it's in a conundrum.
What would make the Fed blink? What would they blink to, given that inflation is the predominant concern? Joining us now to discuss, Invesco's Christina Hooper and Aberdeen's James Athey. Christina, what's your sense of why we're seeing such a market move today, particularly led by the front end of the yield curve?
Well, Lisa, I think about Friday's CPI print as the Fed's bigger boat moment. So you may recall in Jaws, there's this moment in time where Chief Brody is chumming and he actually sees the great white shark for the first time and realizes it's much bigger than he had anticipated. And he uttered to his shipmates, we're going to need a bigger boat. Friday's CPI print was that bigger boat moment, and that's why markets are reacting the way they are, because they believe the Fed is going to be forced to get more aggressive than they had expected.
Christina, is 75 basis points in July the bigger boat?
It could very well be, but we also have to think about the bigger boat in terms of a series of rate hikes. So we're definitely going to get more by the end of this year than previously anticipated, and we could get that 75 basis point rate hike at the next meeting.
James, do you agree?
I love the Jaws analogy to start with. That's a great one. Honestly, I don't know. I come on this show, you know, and I give the same answer when asked about inflation. I don't know. It's a poorly understood concept. It's a highly complicated concept. And right now, it's probably never been more difficult. I think the inflation outcomes are the most important driver of Fed policy going forward. I certainly don't think that a 75 basis point hike is out of the question. I definitely think the Fed would like to probably give a bit of guidance before they take that additional step. Near term, I slightly disagree with Christine in the sense that I don't think that single print necessarily changes things so dramatically. Ultimately, core was lower. Year-on-year core has now been lower for 3 prints in a row. And, it's going to be the path of inflation from here, which is going to be most important for Fed policy, because at the moment, the market is priced for inflation to bounce around about 8.5% for a few prints, and then it's a 7 handle, and then a 6 handle quite quickly. That's what the market is pricing. If that is the path that plays out, no, I don't think we're talking about increasing the pace of hikes to 75, and I don't think we're talking about a higher and higher terminal rate. But if we fail to see, that's reasonably rapid decline in headline inflation over this 3 to 6 month period, then absolutely the Fed will feel compelled to push harder.
James, just quickly here, we're looking at a lot of these moves being driven by the 2-year yield, now at 3.18%. It had been well above 3.2% earlier in the trading session. Do you think that this is overpricing the hawkishness where we are right now?
No, I don't think so. Actually, the conversation we were having as a team last week was that all of a sudden, the Fed being probably the most consistently hawkish across their committee and for a period of time, notwithstanding some of the smaller central banks, but certainly amongst the majors, the Fed has been more consistently hawkish, and yet the US front end actually looked the least aggressively priced, certainly relative to what they were saying. A 2-year yield is going to be an average rate of the policy rate over that period. And what we're not seeing, interestingly, in the strip is a dynamic which which we had seen earlier in this cycle, which was that when we were pricing in more and more hikes in the near term, we were kind of stealing them from the 2 or 3 year view and getting this big inversion. It's not really happening now. The market is just pricing a flatlining of Fed policy rates. And I think when the history is written, maybe that will be the mistake, because ultimately I still think this is an aggressive up and then probably quite an aggressive down in terms of commodity prices, inflation, and then Fed policy.
And perhaps a lot of people would agree with you. Right now, it is the up move that is getting a lot of attention, with the pressure very much front and center for the Federal Reserve. Wall Street starting to price in an outside rate hike, possibly as soon as this Wednesday, with Barclays and Jefferies and Nomura. They are all looking for 75 basis points at this meeting. For more, Bloomberg's Michael McKee joins us now. Mike?
Good morning, Lisa. I love Christina's Jaws analogy, except for one thing. Looking at the shark was a contemporaneous concurrent indicator, whereas the CPI on Friday is looking backwards. And here's something to consider. The Fed has only just begun. Look at how many times in these previous inflation peaks the Fed had been raising rates for quite some time. They've only raised rates twice, and that's only the month of May. So we're not getting a lot of reaction yet in the CPI, because the Fed has only just begun its tightening. Where does it leave us for Wednesday? Well, they said they're going to do 50. I've gone back and forth on this. I think they're going to do 50 because the Fed doesn't really like to surprise people and doesn't want to scare the markets into thinking there's something terrible going on. But we could see guidance from Jay Powell that they will consider 75 at the next meeting. And the way the markets have front-run the Fed, that could do the work of a 75 basis point hike for them. And then we're going to be looking at the dot plot. That's going to be everybody's first thing that they look at on Wednesday, because they want to see what the terminal rate's going to be and how fast they're going to have to go in order to get there. Meantime, how bad are things? Well, the 2-year, 10-year is very close to inverting and going back and forth over that zero line. But look at the 3-month 10-year. They're not going anywhere. They're still way above. So do we have a recession in the future? We don't know. The markets don't know. The Fed doesn't know. That's why you have to stay tuned to the open.
Michael McKee there with a rebuttal to the Jaws analogy. We'll get Christina's response to that in a bit. But Barclays is positioning for a slowdown and persistent price increase, writing, quote, inflation is now dominating policy and likely starting to impact growth as well. Central banks have an increasingly difficult line to tread. We position for slowing growth and persistent inflation, overweight value and defensives to hedge inflation. We are still here with Christina and James. Christina, from your perspective, we've seen such an incredible sell-off in the tech space in particular, with about a 3% decline today. We're talking about the correction in the S&P, but really the NASDAQ has been brutalized this year. When do you start to buy again?
Well, you can start to selectively buy as long as you're dollar cost averaging now. I mean, there are attractive parts of the tech sector. Some areas like spec tech we want to stay away from, but there are some areas that are attractive and I would argue have some defensive characteristics. So this is a time to be selective, but I wouldn't sit on my hands. I would start to dollar cost average in to some of the attractive opportunities in the space.
James, what about you?
Yeah, I wouldn't be in quite such a rush. I mean, I agree with Christina in the sense that there's good and there's bad, there's ugly, all under the umbrella of tech. And certainly the more spec names, those that were just so richly valued, have come down a lot, and they still look richly valued to me. I think, as we saw at the back end of the 90s, beginning of the noughties, there are also probably some growth names, tech names, which masquerading as growth and actually have more cyclicality than investors realise. And so my concern here is that all we've really seen in the equity market over this last few months is a derating, essentially taking out a lot of the pandemic-related froth and other froth. The reality is that earnings forecasts still look pretty robust to me, and earnings are, 30% above trend if you call 7% earnings growth the trend. But we're still way above that, and yet we're talking about recessionary conditions. We're talking about dramatic macro headwinds, really huge macro headwinds, and we've not seen those earnings numbers come down. And once they do, obviously valuations can get richer again during that process, and therefore there is still the potential for some meaningful downside. So equities in general, specifically in the US, I'm still pretty cautious here because I still think we've got some wood to chop with respect to the macro and policy outlook.
Of course, big tech and the call for it, some people would argue, is the haven call amid a slew of uncertainty and fear of a hard landing. The team at Deutsche Bank growing wary of the potential for a soft landing, writing, quote, guiding inflation back to target without triggering a recession has gotten that much more difficult. Achieving such a soft landing looks very unlikely given the degree of tightening needed to combat the seemingly endless stream of inflationary shocks. Christina, going back to that Jaws analogy, do you think that the soft landing is off the table now and it's really about dusting off the playbook for a hard landing, for a recession, and how to position ahead of that?
No, I actually don't believe a soft landing is off the table. Now, admittedly, it becomes more difficult the more aggressive Fed tightening gets. But my view is that while markets believe the Fed needs a bigger boat, it may not actually need a bigger boat. It may need to talk tougher, It may need to be more aggressive in the next few Fed meetings. But we could end the year with a Fed that actually does less tightening than the market currently anticipates. And there is upside potential in that. And certainly it could be that the Fed is able to thread that needle and manage a soft landing.
James, you were saying that the U.S., particularly in the equity space, isn't particularly attractive. Where else is better right now on the risk asset side, given the fact that the U.S. actually has a stronger backdrop than many other places?
Yeah, I mean, that's exactly right. I think the starting point might have been more egregious overvaluation in the US, but some of that was justified given the companies that make up the index, but also just structural growth and economic health in the US. I look elsewhere and I see even greater challenges. Europe, and I include the UK in that, has a much, much worse stagflation trade-off, a growth inflation trade-off. And if the ECB tries to deal with that as they are at the moment, fair play to them, they are trying to deal with that at the moment. But the disruption that can create in financial markets and ultimately economies is quite concerning. In the UK, I'm a little more concerned that the Bank of England is not being as aggressive in trying to deal with it, and that could conjure forth balance of payments forces, which have been incredibly damaging in the past. So everywhere you look, they've got their own challenges. None of them look good. Ultimately, there's a high degree of correlation globally between cyclical assets, and I think we are talking about a global slowdown. I think we're talking about global recession myself personally. So for now, I choose to be much more cautiously positioned.
That's very gloomy. James, we hope you're wrong, although there are a lot of people who probably agree with you. James Athey and Christina Hooper are sticking with us. We want to get a sense of the movement in markets right now as we are poised for a bear market in the S&P with a look at the stocks moving ahead of the opening bell. Abigail Doolittle.
Well, Lisa, keeping with that gloomy view, yes, it's a brutal market here for stocks. The index is down well more than 2%. The S&P 500 futures, as you're mentioning, in a bear market right now, trying to find support. It's going to be really interesting to see what happens today. This, of course, on inflation fears, the idea that the Fed will have to hike very aggressively, as you all have been talking about, potentially yield soaring. Now, the yield curve, however, based off of last week, has really flattened. That's weighing on banks. JP Morgan, Citigroup, both down more than 2%. We also have tech down sharply. That, of course, is one of the most rate-sensitive sectors as rising yields create a valuation concern. Everything gets more expensive, as you know, Lisa, with rates rising, liquidity draining. We're set up right now for a brutal open for stocks.
Yeah, definitely, and we'll be watching that. Abigail, thank you so much. Coming up, U.S. equities teetering on the edge of yet another bear market.
We've had 4 occasions in the last 35 years where the market just avoided a bear market, literally closing down 19.9% and then turning into a bull market.
And that conversation coming up next. And based on where we are in futures, we are poised to open in a bear market with the S&P down right now about more than 2%. And the NASDAQ leading the way lower, as Abby was talking about, given the rate sensitivity there. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special Equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
We've had 4 occasions in the last 35 years where the market just avoided a bear market, literally closing down 19.9% and then turning into a bull market. But on each of those 4 occasions, you had a Fed doing a major pivot, either cutting rates or finishing tightening, and I just can't see that happening this time around.
The global risk rout intensifying, stocks flirting with another bear market, Treasury yields trading at multi-year highs. Rabobank weighing in, writing, quote, collapsing consumer sentiment, unexpectedly intense price pressures, and expectations of Fed activism are conspiring to create a particularly toxic cocktail for risk assets. Bloomberg's Taylor Riggs joining us now.
Let's talk about that toxic cocktail for risk assets. Lisa, we have a great board showing that it really feels like a bond kind of day. When you think about rate of change, a huge increase now for 6 straight sessions of yield higher, some of the biggest weekly moves that we had last week in the 2-year yield since 2008. But as you know, it's also a huge equity story, right? With the NASDAQ 100, with the S&P nearing that bear market. You've talked all about that this morning. But also when you think about classic risky assets, crude, is higher prices really a cure for, well, some of the demand? We're going to find that out in the crude market today. And copper, as we know, sort of a bellwether gauge on the economy, certainly getting hit a little bit this morning, off about 2%. But really, it really comes down to the bond story for me, Lisa. And I know that you've been watching this when you thought about the brief inversion here of the 2s, 10s, and really a huge focus here on the front end of the yield curve, as a lot of market analysts are now really looking for 75 basis point hikes sometime coming by December. I could do all about the bond market if we think that that's where the smart money is, but we'll also talk about the futures as well. I know that we're watching some of the key levels here when we think about where we are in a bear market, maybe around a 38, 36 level, but so far, as you can see, we're here, right off just about 20%. Remember, it wasn't really that far away from that big record high that we had just to start the year.
Taylor Riggs, thank you so much. JP Morgan's David Leibovitz and Morgan Stanley's Dan Skelly saying last week they were staying focused on the stock positioning amid the inflation shock. Take a listen.
Everybody knows that inflation is going to be sticky. We have to differentiate between the markets and the economy. The question that we need to be asking ourselves is, what does this inflation mean for purchasing power and consumption? We continue to favor those global franchises with pricing, with brand equity, that are frankly winning share in this environment. In those types of businesses, those sectors, those industries that have operating leverage, that tends to be more of a value trade.
Still with us, we are so lucky to have Christina Hooper and James Athey. Christina, how closely are you watching the consumer and potential deterioration and how that really affects the risk asset positioning?
Oh, well, we absolutely have to follow the consumer closely. Not just sentiment, but of course, there's concern about the increase in credit card debt and debt in general. So we want to follow that closely. But I'm following it not just from the perspective of the impact on risk assets, I think it's also important to be following it because there is the potential to impact inflation, right? Inflation has this funny way of helping to control inflation by cooling demand. And so if we see consumer sentiment going down, if we see real incomes going down, that could mean a slowing of demand, which is what the Fed is looking for. There are some sources of inflation that the Fed can't solve for, as we know, but what it can do is cool demand. And so if it's able to achieve those goals, then it means that there's less tightening that it needs later this year. So I think it's important to be following this, but for a variety of reasons.
And of course, people hear all this gloom and they look at the tape this morning and they wonder where they can hide. Investors have been piling into cash and stocks amid market headwinds. Not exactly the pair you'd expect. Bank of America writing, quote, inflation shock not over, rates shock just starting, growth shock coming, no release valve from peak in yields, bear market rally to consensus. James, where is the hiding spot right now, given the fact that inflation is eroding the value of cash, that sort of bifurcation right now that you're getting cash and stocks because stocks are a better hedge? What's your view?
You're intentionally asking me these questions to make me sound incredibly miserable on the outlook, aren't you, Lisa?
I'm not doing this to you, James.
Thank you for that. Where do you hide? Wow. I mean, the starting point, if we go back, I mean, even if you go back pre-pandemic, but certainly if you go back to the middle of the immediately post-pandemic period, the starting point was every single asset, financial and non-financial, was about as richly valued as it had probably been in history, and certainly the aggregate overvaluation of assets was on a scale that we've never seen before. As just a starting point, as a long-term investor, not somebody who's trying to make money tomorrow and next week, but somebody who's trying to invest based on a medium-term outlook, that doesn't leave you many options. In the short term, valuation doesn't matter. In the long term, it's all that matters. And history says if you buy equities at 30 PE, you don't do as well as if you buy them at 10 PE. So really, in a situation like this where all the tailwinds have become headwinds, the bond market is obviously adding to problems because central banks are having to catch up and tighten so aggressively, it's very difficult to find somewhere to hide out. Cash, precious metals, some people may choose to see value in certain alternative assets or crypto or what have you, but certainly a significant cash portion, some diversification globally. Chinese government bond yields have been pretty steady, pretty stable through this period. You may have lost a bit on the currency recently, but that still looks an attractive place to be relatively. Do you know, and you know me, I tend to be counter-cyclical in everything I say, but a risky asset class that I think is starting to look really interesting is EM local. So yes, the central banks there were earlier to go, and they've been aggressively hiking in a more conventional fashion. They didn't wait to see the whites of the eyes of 8% in inflation. They got going. So some of those longer dated yields are looking pretty attractive to me. Don't like the currency just yet. I'd still be hedging that. But the long end of the higher quality markets that have already got a significant amount of tightening under their belt, I think you can start to allocate capital there and feel pretty decent that the long-term prospects are attractive.
James, we've run out of time for me to ask you about the weather in London, so we'll have to wait for it next time. James Athey, Christina Hooper with one of the best analogies of the day with seeing that shark coming. Coming up, the morning calls and later retailers bearing the brunt of the sell-off. We'll speak to TPW's Jay Pulaski at the opening bell. Right now, we are looking at steep losses ahead of the open, headed for a bear market in the S&P. The NASDAQ well beyond that. 2-year yields rising to the highest levels going back to the end of 2007, and 10-year yields hitting the highest, prices down, yields up, highest going back to 2011. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Countdown to the open. I'm Lisa Abramowitz in for Jonathan Farrow, poised for a bear market. The losses deepening ahead of this Monday on fears of inflation and higher rates to come. Time now for morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Summit Insights downgrading Micron to a hold, taking a more cautious view toward the memory market amid sluggish channel checks. Next up, BMO downgrading T. Rowe Price to market perform, expecting consistent volatility to threaten upcoming earnings estimates. And finally, RBC upgrading Tesla to outperform $1,100 price target, highlighting the EV maker's favorable positioning and near-term setup. Coming up, it is poised to be brutal. Stocks flirting with yet another bear market. Treasury yields jumping to the highest levels in the front end, going back to 2007. Are we getting ahead of ourselves? That conversation coming up with TPW's Jay Pulaski. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Just seconds away from an ugly opening Monday. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. We can see the red getting redder, particularly on the NASDAQ, down well in excess, well north or south, I suppose, of 3%, down 3.1%. And we can see the S&P deepening their losses, 2.6%. All of this on the heels of higher yields. We could see two-year yields getting to the highest levels going back to 2007. 10-year yields rising almost 13 basis points, 3.28%, the highest level since 2011. Dollar strength across the board. That has been the haven. The euro 104.57, and crude is softening a little bit, but still very much front and center has been gas prices and how much that pressures the consumer, how much that pressures businesses, how quickly that's been moving in the U.S. and beyond. Joining us now with a look at the stocks moving ahead of the opening bell, or at the opening bell, here's Abigail Doolittle.
Well, Lisa, simply a brutal stock market sell-off this morning with the S&P 500, a redhead crossing the Bloomberg right now, saying that the S&P 500 opens on track for a bear market, down 20% from the record. But you made the point earlier that the NASDAQ and so many other markets, they're in deep, deep bear markets already. One reason for this, of course, tech selling off. Take a look at NVIDIA, down 5%. This, of course, as yields are soaring and yield curves flattening. Oracle, which is defensive tech, NVIDIA is growthier momentum tech. Oracle is down 2%. So even your defensive old school tech is selling off on this. But of course, with yield curves flattening so much last week, Bank of America, Morgan Stanley, all the big banks down sharply, down more than 2%. That bank index down 2.5% itself. And of course, Morgan Stanley, not related and related at the same time. Lisa, of course, you know that Morgan Stanley's strategist there, he has been calling for a brutal sell-off for quite some time, saying that the S&P 500 could potentially go to 3,400.
Abigail, thank you so much. A lot of this has been driven by the rates market, the 10-year yield in particular, really driving some of the weakness that you saw in the tech space, surging to the highest level in a decade. It's continuing to factor into the tech trade, which has had its worst week since January. For more, Bloomberg's Ed Ludlow joining us from San Francisco. Ed.
Yeah, good morning, Lisa. We're down 2.7% on the NASDAQ 100, pushing our year-to-date losses on that index toward 30%. You know, how quickly the psychology has changed since Friday, right? Hot inflation print, the market pricing in 175 basis points of hikes before September, and we go back to basics, that higher rates discount the present value of future profits for tech companies, higher multiple tech companies. I always look at this chart. You look at the US 10-year yield. There have been periods of the last 18 months where the yields push higher and tech stocks, higher multiple tech stocks showing some resiliency. Not so anymore. We're above that 3% threshold on the 10-year. And capitulation, do we use that word about the NASDAQ 100? It's a double whammy because there's also the recession fears angle if the Fed cannot deliver a soft landing, which is a window that's getting smaller and smaller, particularly the semiconductor space. You look at Micron, you were talking about this earlier, the downgrade in the market on concerns that memory chips in particular will not have a good second half of the year, softness in the PC market and softness in the smartphone market as well. And now with rising yields, we abandoning the conversation around dividends, right? Stocks that are paying out. Oil and natural gas producers, really interesting. You look at how they perform, but I think Bloomberg Intelligence has this idea, right, that $63 billion of free cash flow in that sector over the next 2 years. It could be one pocket where dividends continue to come, because what else are you going to use the cash for?
Ed Ludlow, thank you so much for that. It's not just big tech, it's also big box retailers feeling the bite from surging inflation. Global retailers, including the likes of Amazon, Target, and Walmart, on pace for their first year of decline since 2008. Taylor Riggs of Bloomberg joining us now for more. Taylor.
Well, Lisa, I think it's great that this is following the segment on technology, because we thought tech was bad. We thought the NASDAQ 100 was bad. Take a look at some of the individual sort of sectors that we have for some of these retailers. And again, sort of underperforming, even big tech, going back all the way since about 2008. So some big sort of underperformance here when we think about maybe the, and I don't want to say mismanagement, but the double ordering to get ahead of all of the supply chain issues. And then, of course, now the discounting, as you mentioned, Target, and sort of what follows when you think about the pressure that puts on margins. Change up the board here, because I think that it really has been all about this inventory story, not getting your hands on enough inventory. So all of that double ordering and now the discounting that comes with that. The only maybe good news from this, Lisa, is that all of that discounting could be heavily deflationary. And when you think about all the discounting that is passed on to the retail and to the consumer, that actually might be a bright spot. But as you can see here, I mean, there's only one member within the retail index within the S&P that is positive for the year. Guess what that one is? It is Dollar Tree, which gives you a very good view here on the consumer, the search here for what they can afford, and of course the reflection in that within these equity markets.
Taylor Riggs, thank you so much for that. Morgan Stanley and Goldman Sachs issuing a warning to investors exactly on the heels of that. The risks of facing in earnings have yet to be priced in. The team at Morgan Stanley writing, quote, the equity risk premium does not reflect the risks to growth, which are increasing due to margin pressure and weaker demand as the consumer decides to hunker down. For more, Bloomberg's Keely Lyons joins us now. Keely.
Well, Lisa, if anyone out there is hoping that maybe this is the worst of it, that now that the S&P 500 is on track for a bear market down 20% from its record high, maybe the bleeding will stop in the near term, Mike Wilson and David Kostin would beg to differ and throw a little bit of cold water on that entire thesis. For David Kostin's part, he says despite the sell-off we've seen in the S&P 500, valuations remain far from depressed and that earnings estimates are still too high and he expects them to be revised even further downward. Though it's worth noting his base case is still that the S&P 500 manages to end the year at 4,300, so about 10% north of Friday's close. Meanwhile, Mike Wilson decidedly more pessimistic. He is warning on that risk premium, as you mentioned. Right now, that S&P 500 earnings yield subtracted by the 10-year yield sitting around 200 basis points or so. And he says that as recession risks grow, the equity risk premium should be higher until earnings estimates are cut. Now, his second warning surrounds consumer sentiment, which of course data showed on Friday has plunged to the lowest level since 1978, looking at those University of Michigan data points. And he says that that drop in sentiment poses a risk to the economy and markets from a demand standpoint. He talked about that excess inventory that Taylor was just detailing as well, saying that that is just now beginning to be reflected in stock prices. So where is that going to leave us eventually? He says he's looking at mid-August and he sees 3,400, Lisa.
Keely Lyons, thank you so much. The S&P could be heading even lower. That's the view from RBC's Lori Calvasino, who joined us earlier this morning. She writes the following, quote, we see potential downside to a little over 3,200. That would represent a 32% drawdown in the S&P 500 from the early January 2022 high. Joining us now, so happy to say, TVW's Jay Pulaski. Jay, do you agree? Are we headed to 3,200, or is this the cathartic puke that marks a bottom?
My God, Lisa, I mean, after that opening, I just want to crawl under my desk.
I think a lot of people do. I think you're not alone. So give us some, cathartic puke talk.
Yeah, give us something to look forward to. I mean, I don't know really who's selling after the worst back-to-back 2 days and over 2 years. I mean, I think you got to really be negative to be selling heavily this morning, and that's not where we sit. So, I mean, I do think there are some pockets of decent news. There are parts of the world that are outperforming. There are parts of the market that look like they're bottoming. For example, NASDAQ new lows on Thursday and Friday were well short of the new lows in mid-May. And so we're doing what the market does. It's a bottoming process, not a V bottom. And I think testing the lows of May, and we'll see whether we break considerably lower to the levels that you were just noting, 3,400. And I think that depends on whether or not we go into a recession. And I don't think that a recession is baked in. I think, in fact, we're getting close to levels where we're starting to see demand destruction in the energy space. We've been waiting for Godot for inflation to peak. Core has clearly peaked. And I think there's a case to be made that inflation will continue to ebb as we go over the next several months and quarters, whether it's softening labor market, easing housing, AHE, average hourly earnings, having clearly peaked, the one-off airfares up 40% year over year. Those types of things start to fall out. And you have a handoff from goods inflation to service inflation. And I think that is a recipe for gradually rolling lower inflation. It's probably not going to be as low as I was thinking a month or two ago. So maybe 4% as we end the year. And we have 2.5% growth, so nominal growth of 6 to 7%, which I'll remind everyone is a full 2 percentage points above the nominal growth levels we had pre-COVID. So we are cheaper today than we were pre-COVID in terms of the S&P on an equal weighted basis, selling at 15 times earnings. Earnings growth is better And unless we go into recession, that earnings growth should hold up. And therefore, you have an opportunity for high nominal growth, which supports the earnings growth. I think people still fail to grasp the importance of high nominal growth as it regards to earnings. Earnings are denominated in nominal dollars.
Jay, would you be buying right now? I mean, the S&P just hit its lowest going back to March 2021. Are you a buyer based on what you were saying?
Well, you know, I wrote our monthly 2 weeks ago, and the title was The Time to Market and the Time to Invest. And clearly, it's not the time to market, Lisa, right? IPOs are shut, no high-yield issuance in the United States, SPACs imploding, et cetera. Is it time to invest? I think arguably it is time to be looking to be more of a buyer. If you have a 1 to 2 year type of view, time frame, which is what we have at TPW Advisory, Europe looks good to us, China looks good to us. The credit space in the U.S. looks good to us. We're getting paid to take risk. And we think the innovation space, which went into the bear market first back in February of 21, is looking like it's trying to bottom. And I'll just note, we run 2 model portfolios. In our thematic model, 16 of the 20 positions are outperforming the ACWI month to date. And in our global multi-asset model, 21 of 28 positions are outperforming. So value, energy, gold miners, commodities, China tech, there are opportunities in areas where one can position, I think, even in this market. It doesn't have to be all about the U.S. In fact, we're deeply underweight the U.S. equity market.
Models start to break down when you factor in recession. Citigroup came out and said the premium for commodities is adding to the risks for growth, writing in a note, quote, the longer the commodity shock persists, the bigger the negative impact on commodity consumers and on net global growth and equities. How does that pressure fit into this look outside of the U.S. to other commodity importers at a time of slowing growth and China not being the marginal driver of extra points for the GDP?
Well, I think China is probably bottoming. And if you look, their aggregate financing in May was up 30% ahead of consensus and triple what it was the prior month. You have markets like Brazil, which epitomize physical assets, whether it's food, minerals, or oil. It's off about 15% over the last couple of weeks. It's an opportunity to add there. And I think people, again, tend to forget that the percentage of disposable income used to purchase food and energy today is much less than it was in the 70s and 80s. We use much less energy today to generate GDP than we did 30 years ago. It's not the same environment.
Jay, you're sticking with us, and we're going to be speaking about China grappling with headwinds from home and abroad.
We seek a region free of aggression and bullying, and we seek a world that respects territorial integrity and political independence.
The conversation not only about the economic headwinds, but also the political ones as we discuss Taiwan and the potential for further disruption in international relations. Right now, we are looking at steep losses, the S&P down 2.7%. The NASDAQ actually clawing back some of the earlier losses, though still down steeply, more than 3% now. So really adding to the losses to near 30% decline so far this year. This is Bloomberg.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
We seek a region free of aggression and bullying. And we seek a world that respects territorial integrity and political independence. And we feel the headwinds from threats and intimidation and the obsolete belief in a world carved up into spheres and influence.
Headwinds piling up at home and abroad, China grappling with pushback from the United States. This coming as the country starts to reimpose COVID restrictions. Bloomberg's Michael McKee is back with us for more. Mike.
Lisa, it's more bad news from China. China can't get away from it. COVID now making a reappearance in a big way in Beijing. 45 cases reported on Monday afternoon. That follows 37 in Shanghai. Shanghai had gotten down to single digits. And so at this point, we are looking at the possibility of another big backup in Chinese supply chains. And these are the ships that are waiting offshore and the supply chains that are waiting to be filled in China. And all that has to come to the United States and to Europe. And so it looks like we could have more economic problems. And of course, the problem that we have on Wall Street is that business is not very good in China right now, in part because of all this, in part because of the Chinese government, which has called in a number of bankers, including Credit Suisse, Goldman Sachs, and UBS, to say, watch how much you pay your bankers. We don't want them to be overcompensated. It's part of Xi Jinping's efforts to create a more equal society there. And that doesn't really go well on Wall Street. But you saw the chart. We are seeing a lot fewer IPOs of Chinese companies because, well, we don't know. Is it because of the business they're doing with Wall Street, or is it because of the lockdowns, or is it because of just a general bad news in the markets kind of thing? This is the problem going forward, Lisa, as we try to figure out what's going on with China. So many things that it's hard to put a finger on just one.
Mike, thank you so much. Sticking with China, although we do have an eye toward markets with them really whipping around the NASDAQ, really and particularly volatile ahead of the Fed on Wednesday, possibly signaling a more aggressive tact. In China, a growing number of firms on the street have actually been turning more bullish on that nation's stocks, with the team over at Jefferies writing, quote, China is almost operating two economies in parallel. The first is the COVID economy requiring mass testing at times and an ongoing reporting of infections. Meanwhile, the real economy is helped by the government's supportive policies. Jay Pulaski, who is also seeing value in some of the equities and other assets in China, joining us now. Jay, how much is that kind of policy support underpinning the reason why you see some signs to be optimistic there?
Absolutely critical, Lisa. I mean, you think about the policy mix in the United States, it's probably the worst of the three main regions, the Americas, Europe, and the U.S., with tight fiscal and tight monetary policy. If you look at Europe, it's loose fiscal and starting to move into tighter monetary, but very slowly. if you look at Asia, and I would include Japan in this, you have both loose fiscal and loose monetary policy, and that is supporting financial assets. And I noted in the prior segment that the aggregate financing in May in China was 30% ahead of consensus and triple the prior number. So we look at KWEB, which is the tech stocks. We look at the A shares. We have both in our model portfolios. KWEB bottomed back in March, 3 months ago. The regulatory picture is getting better. Valuation is very compelling. They're trading at half the multiples of the NASDAQ 100. And so to us, it's one of the real opportunities, and we're overweight China assets, both stocks and bonds.
Jay, a lot of people make this argument that you follow the policy prescription, you follow the one that's most accommodative. When does that break down in the face of inflation, given the fact that in the United States, yes, there is an expected greater tightening than in other regions, but it is also in response to that nominal growth that's supporting some of the earnings that we've seen so far?
No, you make a great point, Lisa. Inflation's key. And in Japan and in China, guess what? No inflation. Right? I mean, Japan is happy to have a little bit of inflation finally, which is why they're not pushing back so aggressively against the weakening yen. And in China's case, CPI for May was 2%, and PPI, which is what people focus on from the industrial side of the economy, was half of what it was in the prior month. So it's gone from 12% to 6%. So there really isn't an inflation issue in China, and that's what allows them to have the policy flexibility, which they really haven't put to use. We've been actually disappointed at the degree of policy flexibility shown by China, perhaps because there's some dichotomy in the upper levels of the Communist Party over how to address that mix between zero COVID and keeping the economy on track.
I got to say, Jay, I like your brightness. It's a good antidote to some of the gloom that we're seeing right now. Just to give you a sense, the NASDAQ's down 3.1%, the S&P down 2.5%. Two-year yields markedly higher than they were earlier this morning, although they've been bouncing around, but solidly above the 3.2% mark after having fallen below that. We are looking right now very much at a bear market, but we're also looking at dollar strength. Jay, when does that break down if what you're saying is the right way to look at this? Follow the policy support, not necessarily where the strength in earnings is now.
Yeah, no, again, Lisa, you're right on it. I mean, the dollar has, in our view, we've been wrong about the dollar. We've been expecting the dollar to roll over. It's really hurt in terms of the ability to hedge some of the non-U.S. equity, which we didn't do and we should have. But the dollar's not been able to really break out here either, even with rates, as you point out very correctly, really leading the process. To us, this is a rates-driven market. The 2-year, the front end in particular, has soared. It's risen about 280 basis points since the Fed started to tighten. Typically in a whole cycle, the 2-year doesn't rise that much. The average at this point in a Fed tightening cycle for the 2-year is less than 100 basis points. It's almost 280 basis points so far in this cycle. We have front-ended an awful lot of this. If we get one, we talked about the carthetic puke. If we get one real inflation number that's soft and allows people to really commit to the idea that the core has peaked and is rolling over, then we get an absolute, buy that goes crazy. Otherwise, maybe we need that cathartic puke, that VIX over 40, to really get people to come back in. To me, the last couple of weeks, the action in the market hasn't been heavy selling. As I pointed out, new lows in the NASDAQ were small. It's been lack of buyers.
Yeah. Jay Pulaski, thank you so much for that insult and that point, for not that insult, for that insight, I should say. I really like that point that you were making. That's where I was going with that, that really it's been a lack of buyers. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. This is Bloomberg.
exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front row, the best seats in the house for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Farrow. Time now for the trading diary. What you need to be watching this week. U.S. PPI figures coming on Tuesday. Retail sales out Wednesday, followed by a trifecta of central bank rate decisions. First up, Fed and Chair Powell's news conference on Wednesday, the Bank of England on Thursday, and finally wrapping up the week with the Bank of Japan on Friday. Right now in markets, it has been an ugly start to the day, although you do have some who are starting to creep in to buy. NASDAQ down 2.8%. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in sari-sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
The news of the bombing came out. It was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf.
Hello, traders again. I'm going to move even to better advantage our stop for British pound. So I'm going to move to 121.8. Okay, it will give us £5,000 in profit. Okay. I'll take 21.8. Just right here. Okay, guys, please move your stop. So you will have, in your case, depends how much you decided to invest. 1 pip in our case cost £100. As you can see here will be, you can count how many pips. So in our case, we made 50 pips. This will give us £5,000. Okay, guys, I'll speak to you later.
The attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wiener Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years.
However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000. Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech in right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system. If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us. The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse. How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest flight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor. Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, and language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings, as well as you're going to describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be in the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into a medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We got a lot of extracurricular activities and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were in those days I'm talking about. So the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again try to excel in academics day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.